Good morning. Call the August 27th, 2025 Investment Advisory Committee quarterly meeting to order. Welcome, everybody. We have a full crowd of a lot of our team, but also some external people as well, particularly the Ortec folks and the RBK folks. Thanks for being here. For the IAC members, particularly thank you. As I think many of you know, we anticipate this to be the last formal meeting of the Investment Advisory Committee, given that the North Carolina Investment Authority Board is in the process of being formed. We'll have the inaugural meeting for that body after this. So we thank you all for your service. We'll come to that more formally later. We would not be able to have the successes that we've had without you. So thank you very much. Appreciate everyone being here. With that, would everyone join me in the Pledge of Allegiance and the salute to the North Carolina flag? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the Old North State love, loyalty, and faith. Thank you. Jason, will you please call the roll?
Absolutely. Good morning, everyone. My name is Jason Sass, and I serve as Deputy General Counsel at the North Carolina Department of State Treasurer. First, I'll take roll call of the committee members to confirm we have quorum. Then I'll go over a couple of reminders for our public meeting. All right. For the roll call, Mr. Lentz Brewer.
Present. Good morning.
Morning. Mr. Robert Durden.
Present.
Mr. Michael Kennedy.
Present.
Mr. Jamie Spencer.
Present.
Mr. Dan Ward.
Present.
And Treasurer Bryner.
Accounted for.
And we have quorum. So thank you, committee members. Here are some quick reminders for our public meetings. For those who have called in, please remember to mute your phone when you are not speaking. Please state your name when making or seconding a motion. If you need to leave the meeting, please speak up and let us all know. And if you rejoin, please identify yourself. For anything that this committee votes on, the votes will all be by roll call. You'll deem the members who make the motion and second it as voting yes. Finally, a reminder to anyone speaking from the audience during this meeting, please remember to stand and clearly state your name, title, and organization for the record before proceeding to speak or answer a question. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website at www.nctreasurer.gov at the Investment Management Division, but if you use .com, it will redirect. If you lose the phone line connection, the meeting will be deemed to be in recess, and we will put a notice on the nctreasurer.gov website when we have information about a time to resume the meeting. All right. Are there any questions about these procedures? All right, thank you very much. At this time, I'll turn the meeting back to the chair for approval of last meeting's minutes.
Thank you, Jason. So the first tab in your materials are the May 28th, 2025 meeting minutes. Are there any questions or concerns, or does anyone want to make a motion to approve?
So moved. Second.
Thank you.
All right, for the roll call, Mr. Brewer. Mr.
Present.
Spencer. Mr. Ward.
Aye.
Yep.
And Treasurer Bryner.
Aye.
All right, we have approval.
Perfect, thank you. Let's move on to the major initiatives. Over to Kevin Sickers, our CIO.
Good morning. So I'm going to cover the three major initiatives that we've been talking about so far this year: rebalancing, governance, and then the asset liability study, which is its own agenda item. So I'll have more to say about that during that item. So on the rebalancing, where we started this year was really the use of the excess cash. So we had about $2.8 billion in February that we redeployed. It was about 40% of the excess cash at that point in time. Beyond that, what we've been doing on the rebalancing front is really through commitments to co-investments, new funds, So in addition to the 2.8, we've done almost 700 million in actual cash outflows for these new investments, not just the commitment side, but actual cash. So we're up north of 3 billion now in terms of redeployment. And then the rest of the rebalancing has really just been by virtue of the fact that equity markets have been particularly strong. And we have this long-term discipline of plus or minus 2% relative to our strategic asset allocation for the two liquid asset classes. And we've had multiple rebalancings. So we did one in April. We talked about that at the last meeting. But since the May IAC meeting, we've had another rebalance in June, where we moved roughly 1% of the fund out of equities because we got pushed through the top end. And you can see what's happened through the 8/11 anyways, in terms of our changes in our asset allocation. So just to kind of highlight where these rebalances have occurred, and then also where we expressed a judgment, we recommended to the treasurer to waive our rebalancing for a period of time. So we had this just shows the kind of the movement of the two main components of our public equity portfolio and how strong the performance has been since April. We had that rebalance on June 2nd, and then we triggered on July the 21st. So with perfect hindsight, we wouldn't have rebalanced on the 2nd of June. We would have just let it ride. But we did follow our discipline. And on the 21st, though, we felt that there was sufficient reason to do a waiver, given how constructive we were on the equity markets, and then the kind of the alternative use of the dollars as well, right, which is also relevant. So we asked the treasurer for a waiver that was granted. That waiver expired after 1 month, and we've subsequently done a rebalancing. So we've gone back to the rebalancing, and we had a fair bit of discussion in our investment committee around what had changed since we asked for the waiver. And really, we felt on the margin that it made sense to kind of take a little bit of money off the table. So we did that. And we're about halfway through that rebalance, I believe. We were able to do a big chunk of it, about 500 million within 1 day internally, because we have these large index funds on the domestic equity side. And then the rest will come from an external manager that we're terminating. So that's the rebalance side. On governance, good progress, some of which you'll get a further update today. So we had the Investment Modernization Act signed by the governor in mid-June. We've had 2 board and director members appointed. We're going to have our inaugural meeting later today. And then the transition activities within the department, I'll address that during the board meeting later. RVK, a consultant that's helping us with the evaluation of our governance, operations, investment practices. That has to occur every 4 years under the statute. So they'll be giving their report today. We've updated another 2 policies, which will take effect in September. The transaction disclosure policy deals with placement agents, which are not a huge part of the market these days for us. But we've also used it to as an opportunity to update the policy to take into account that as we do more directs, there's certain market standard activities like commercial real estate brokers that raise monies for deals, transactions, whether it's equity or debt, and we don't consider them to be placement agents. Same for investment banks. So we've just clarified that to facilitate what we expect to be more activity in the direct space. And then the proxy voting policy has also been updated, mostly to make it more narrowly focused on voting using proxy advisor guidelines, which we reviewed and we review annually. And the idea is to focus on core corporate governance activities, but otherwise to abstain from voting if it's not a core activity. So what's a core governance activity? It would be appointment of auditors, it'd be changes in classified boards, any number of these kind of basic things, stock buyback, proxy votes, M&A activity. So we view those as core to what a company needs to do. from time to time, and then we'll exercise our votes there. But if it's advisory, if it's outside of those core governance activities, we're basically silent unless there's special circumstances. And then the last thing I'll note on the governance side is we have made our transition away from the index fund exposure in Chinese and Hong Kong holdings. So that's been completed as of late July, and it's gone very smoothly. We had maybe about 9 basis points of total transactions costs associated with that transaction. And we worked with transition manager and the index fund provider, which are the same company. And so that worked out fine for us. And we're pretty much exited. We actually were selling through that whole time period into the strength of the Chinese and Hong Kong markets. And so far it's gone well. We'll see how it goes in the future. Okay. And then the last thing on human capital is we've continued to push forward on adding to the team. So since the May IAC meeting, we've added 5 more people, and we're now up to 35. We have an opening in internal fixed income, and Jeff Smith's team, he'll be up later today to talk about that investment program. And we have an analyst in public equity in a vacant position we're trying to fill there as well. We're adding 2 administrative assistants. We've had 1 long-term administrative assistant, and we really need more. So that's coming as well. And then our market-oriented compensation study, we're in discussions with a finalist consultant. So our expectation is that we'll kick that off in September and be able to move forward. And then that'll be an item for the NCIA board as well. Yeah.
Hey, Kevin, quick question. Can you said this before. I know our total staff is low relative to similarly sized pensions, and you've been building very well this year. Can you remind me though how our staffing, particularly investment side, relative to a similar pensions?
Yeah, so we've got peer data that we've looked at. It's a little stale. I think it's from 2023. Yeah, it's the most detailed, and we're probably at about half staffing compared to our peers. And I think, again, I feel like I'm going to say this a lot, but when we get with the North Carolina Investment Authority Board, that's going to be a key discussion around staffing. What's the operating model in terms of like, what do we do internal versus external, not just on the investment side, but some of the support services as well. And that'll be an important discussion, I think, strategically. We're not peer driven in the sense that we want to look just like a peer group and do just what peers do, but we certainly should have kind of informed, intentional decisions around those organizational design and insourcing versus outsourcing type discussions. Yeah. So that's it for my major initiatives. Like I mentioned, the next presentation agenda item is the asset liability study, which I'm going to do an intro to. So I'm going to hold off on my comments for a sec. So happy to answer any other questions around the major initiatives. Okay, cool. We go to the next item then? Why don't we have the OrgTech folks come up as well? So we're going to do this in 2 pieces. I'm going to give an intro, set a little bit of North Carolina context around the asset liability study, and then OrgTech is our consultant, and they'll do their own intro because they have some nice background slides, and I can answer questions about their business directly. And they'll be focusing on their methodology, the capital markets assumptions that they utilize as kind of their standard, within their standard studies. And the expectation, the hope is that we'll have some discussion around those capital markets assumptions and so on. So as a reminder, these are the dates, the key dates for this project. This is our August consultation with the IAC. And then when we get to later this year, we'll be working with the plan actuary to get an update on the experience study. So what the experience study does for a defined benefit plan is every 5 years, actual data that's relevant to the actuarial assumptions is gathered, and then it's compared to see if the assumptions need to be updated. So these are things like lengths of service that typical members stay within the system as active employees, rates of salary growth, mortality, things like that. So they cover the whole gamut of all those assumptions, and it's a good opportunity to update the actuarial assumptions. So the retirement boards are the actual entity that approve those assumptions. They'll do that in January next year. Between now and then, we'll work with Plan Actuary, Retirement Services Division, and then come back in November with our first pass at recommendations change to the strategic asset allocation and a number of other things, which I'll cover in a second. So this is a kind of an abstract overview of what we hope to accomplish with the asset liability study. And it's really just trying to knit together all of the financial drivers for the retirement system. So the way I think about this is on the left-hand side where you've got the blue shaded boxes. These is essentially how the future obligations, the future financial obligations, or what we call the liabilities, are determined. There's a whole series of somewhat complex rules that get administered by our Retirement Services Division. They're unique to each of the plans that are underneath the North Carolina retirement system. And the key ones that you should think about are there's a multiplier times years of service times average high compensation. And then there's a number of other kind of rules around that. You feed into that the demographic factors, which are things like length of service, mortality, and then the economic factors, which are more around like real wage growth, inflation on top of real wage growth, and the actuarial assumed return, which is the discount rate. So those blue boxes represent what's going to actually happen. So we can't know, no one can know exactly how that's going to play out over time, but it will be what it will be. So think of that as at some point you can look back and know what the actual obligations are and the payments that have to occur under the law. And then the right-hand side is really a budgeting exercise. And the fundamental kind of balance point is around how much of those estimated, now we'll move to the projection world, how much of those estimated benefit payments are going to get paid by contributions, whether it comes from the employers or the employees, or investment earnings. Very simple teeter-totter, right? You want to get that balance struck as well as you can. On the contribution side, normal cost is just if everything works according to assumptions, this is what should get paid in the form of contributions. So for North Carolina, it's about 12%. And for unfunded actuarial liabilities, that's a balancing contribution. So to the extent the plan gets underfunded, then the methodology calls for new funding to come in the form of those unfunded accrued liability contributions. And if it's overfunded, then that number can go down or even be negative. So on the investment side, there's the actuarial rate of return. And this is the discount rate for the liabilities to calculate the present value. There's kind of a tendency for folks to think about the actuarial return as like, that's what we need to make for the investment program. As long as we make that return consistently over time, then everything is fine. In reality, it's a little bit more complicated in the sense that the actuarial method takes and comes up with the actual rate of return based on our asset allocation and based on their capital markets assumptions. So while it simplifies our life if we say we need to make 6.5% annualized over long periods of time. It's also the case that that 6.5% comes from the actuary looking at the strategic asset allocation that gets set, and then references their capital markets assumptions as well. So there's a little bit of circularity in terms of this actuarial rate of return. When the IAC has weighed in on this in the past, the treasurer's made their decision, or in the future, the NCIA, they take into account investment objectives, risk appetite, the liquidity needs, and any legal limitations on how we actually invest. So the study that will be done will ultimately be looking at how different strategic asset allocations can impact the future funded ratio for the plan, contributions, not just long-term, but how much they move up and down in shorter periods of time, and then also the retiree cost of living adjustments.
Kevin, while we're
Optional.
on that topic, the actuarial rate of return, has that changed much over the last 10 years?
It has changed, yeah. And so, Chris, how much has it changed?
Yeah, it was 7.25% for a long period of time. Then it got moved down a couple of times, 7.2 and then 7, and now it's 6.5. So I think that was done in 21. Is that right? I think it moved to 6.5 since then. But yeah, so it was 7.25 for a couple of decades.
The whole industry has moved that way. 6.5 is a little bit below average, but not a lot below average.
Yeah, I think that's accurate. People are moving towards us.
Yeah.
These are the current investment objectives. So I'm not going to go through these in detail, but the first one is essentially saying that we should be investing over the long term so that the plan is fully funded, simplistically, and that long-term contribution rates are at a reasonable level, right? And that's obviously in the eyes of the beholder. And then emphasis added to this line, which again is we should be aware, cognizant of what the assumed investment return is, and take that into account when we're investing. The second one is about avoiding excessive volatility in the contribution rates, because that creates a massive shock for the stakeholders, namely the employers within the system and the state budget. Number 5 is always important to ensure that we have sufficient liquidity. And then the last one is complying with all the governing statutes and fiduciary obligations. These are the statutory limits that we've operated under for quite a while now. And they've been limiting in a number of cases over the years, particularly as the public markets periodically go through a down spell, and we have a denominator effect, so to speak. This is the new world based on the adoption of the Modernization Act. So the statutory legal limits now have been reduced to 2. So this affords the investment program a lot more flexibility. We'll have to have a minimum of 20% in investment grade bonds, doesn't specify duration, and then a maximum of 40% in illiquid investments. And then the governance has been updated significantly, not just the creation of a board, but in terms of how we think about striking the strategic asset allocation and how we implement over time. At least every 2 years, the new board of directors must approve an absolute risk operating range, which is essentially stocks versus bonds. So equity and debt allocation equivalency terms. So this will result in us thinking about the portfolio as a reference portfolio, coming up with a basic risk appetite, growth versus exposure to rates and liquidity. And then that operating range has to meet 3 criteria. The first 2, pretty classic. We have to maximize long-term returns, but we can't take undue risk relative to other similarly situated public pension funds. So historically, North Carolina's investment program has been low risk in the sense of trying to avoid market volatility. So there's been a high allocation to fixed income, very high grade investment grade fixed income. relative to other public pension funds. So the thinking is that as we come through the study, we'll see the benefits of re-risking, adding a bit of risk, but not going beyond what we assess as similarly situated U.S. public pension funds. And then the board of directors has to take into account all of these factors that are relevant in trying to understand the impact on the funding ratio, the contribution rates, the financial circumstances of the plan. And then the board of directors will make a recommendation to the retirement plan boards as well, who have the ultimate authority to make those decisions as to set the contribution rates, the actuarial assumed investment return, and those types of things. So defining the risk of a similarly situated U.S. public pension fund. Again, this will be the first time that we go through this in this study. So our early thinking is that we would look at funded status, size. Those are easily observable. Risk appetite, not so much. But if we have a small enough peer group that we can look at for this, then it'll be fairly straightforward. The inflation sensitivity of the liabilities. So that's a function of statutory COLAs or optional COLAs for retirees, as well as how the formulas work. And then we can look at the maturity of the plans in the sense of how much goes out the door in net benefit payments as a percent of assets, or we could look at the ratio of active employees to retired members and terminated vested. And then the risk dimensions that we would look at, again, are equity and bond equivalence, kind of that basic split, the volatility of returns, volatility of the funded ratio, contribution rates, and then illiquidity. So these are the key areas of focus in our study. We're going to separately model the two largest plans that are covered in the North Carolina retirement system, Teachers and State Employees Retirement System and local government. They're both similarly funded. They're quite similar in terms of the investment group or the benefit rules, but we're going to model them separately. We're going to map all the asset classes into that debt versus equity. So that will, for example, require us to do a mapping of real estate. Then we're going to reassess the structure of several of the asset classes as well as their benchmarks. So in each of the prior asset liability studies, we've looked at various structures for our investment grade fixed income book. We've looked at longer duration, shorter duration, a blend, something that might be similar to an off-the-shelf Barclays Ag duration or an intermediate duration. We've always come back with the benefit of having longer duration when we do this analysis and asset liability study, but we'll revisit that again. Opportunistic fixed income, we're thinking that we're going to look at a broader multi-asset class credit portfolio, and that's where all of our non-investment grade public and private credit would go. Real estate, we've had that separated over time since I think about 2013 or 2014 into non-core and core real estate. We're going to look at just combining that, and then how we think about the real estate portfolio construction over time. And then inflation sensitive has been a mix of public and private investments. We're going to look at more of a standard or classic real asset structure with infrastructure, natural resources, and ag. We think that that might be a better fit. When I look at our allocation to infrastructure in particular, as well as the natural resources area, the privates, we're significantly underweight, not necessarily versus other public pension funds, but certainly what I've seen globally. And I think there's a lot of attractive opportunities in the infrastructure space. And then the way our process works, and I'll step in during the ORTEC discussion as well in a second, is you set assumptions, you do optimizations between risk and return, or the opportunity set and the risks associated with it. And rather than say, okay, this mathematical calculation of an optimization, pick this portfolio, what we do is we come up with judgmentally based candidate portfolios that we think make sense from an investment perspective and based on what we see in the market opportunity and risks over the next 5 to 10 years. And then we have the measurements of how well those kind of candidate portfolios fit with these optimizations. So we're not trying to be mathematically driven and mechanical. What we try to do is take our investment judgment and our views on the markets, and we test that against what is an optimized portfolio. And if we think we can demonstrate that we're close enough to what's optimal and we can show the trade-offs, and our trade-offs are around, stress testing in terms of bull and bear markets, what if there's stagflation, any number of different scenarios, then that's the basis for what we'll end up recommending. The other two things that we'll look at are the length of the amortization period. So when there is an unfunded actuarial liability, North Carolina amortizes that over a fairly short period of time relative to other peers. And so we'll be able to show, to the extent that the retirement boards want to adjust that assumption, or the actuaries recommend it and the boards adopt it, how it would impact our investment program and the risk profile. And then we'll look at the ability of different candidate portfolios to impact the probability of retiree cost of living adjustments. So the retiree cost of living adjustments only occur if we beat the actual rate of return. So there is, again, this connection back to what that discount rate is in that assumption. Okay, I'm going to stop with this. This is just a grid of trade-offs. Again, we'll come back and be able to show the actual trade-offs when we come back in November with the board. And in essence, opportunity metrics are, good things that we'd like to have happen, be fully funded, the plans be fully funded over time, but then there's risk around that. And likewise for employer contribution rates, total cost of contributions that come in, our liquidity scoring and things like that. So I'm going to stop there unless there's questions and turn it over to Ortec. In your appendix of the slides, for those who are particularly interested in this topic, there's a simple mechanical chart to show how these things work in an ALM study. And then we have some peer comparisons from the end of 2024, which kind of show where we stand, which again are consistent with my earlier comments that we've had a very heavy reliance on investment grade fixed income. I think we're about, depending on whether you look at actual or policy, we're about 15% overweight in pure investment grade bonds relative to our large peers. So. Okay.
I have a question, and it could be as you guys are talking through this, can you talk through how you marry the reality of the lack of illiquid mark-to-market to the assumptions? Like you guys have the wide standard, the proper standard deviations, but we all know in reality that never happens, and how that impacts maybe the ALM side of things, because it won't mark-to-market over time.
Yeah, so maybe some of that will be answered, I think, as we go through the presentation. I think from a risk perspective, it's two different dimensions of risk, right? One is the mark-to-market concept, and we want to look through the fact that there is some smoothing for, say, real estate and private equity and some of the private credit, because over a 1-year time period, that smoothing is real. And it comes into our performance measurement. But if you look over 5-year time periods and longer, then the true underlying market volatility is there, right? It just takes a while to kind of come into the numbers. So when we're doing long-term planning, we have to recognize that over longer periods of time, that smoothing just evaporates, just goes away. By the same token, over shorted periods of time, we have to manage the rebalancing. We have to manage to ensure we have sufficient liquidity to make the benefit payments, the capital calls, and things like that. So it's really a blend of the two. Planning is different than the actual management in the short term. Hopefully we can shed more light on that in a sec.
So Kevin, I've got a question because you're talking about the opportunity metric and looking at the funded ratios. So they're going to come back and give you different scenarios. under which you will be able to see what the funded ratio may be. What is the overall philosophy about ideally what your target may potentially be from a funded status? Because take, for example, New York State Common, and they want to be 100% funded, and that's kind of their goal. So, so do you have any sort of thinking around what the ultimate funded ratio? Maybe you're not really focused on mandating it needs to be 100%, but where would you be sort of comfortable? Because there's going to be a range.
Yeah, to me, it's most natural to say that, over some horizon, might be 10 years or 15 years, the plan should be full funded, right? And so I think it's typical in the studies I've worked on in the past to show what the existing portfolio is likely to do in terms of getting to that goal versus others, other strategic asset allocations. But I think that's the most reasonable. And given that the plans are well funded to begin with, I think that's entirely credible. I think the other dimension, though, is to the extent we overreach to try to get to that full funded status, we can take on more downside risk, right? That in shorter periods of time, the funded ratio can draw down, which has real world consequences, both in terms of contribution rates spike, and that has budgetary impacts on the stakeholders. And then it also, pretty much eliminates the ability to provide cost of living increases to the retirees. I think policy-wise, there's always a question as to, these shared kind of obligations and shared burdens of should the retiree cost of living adjustments be carried by the investments, or should it be carried by contributions? We can't solve those, but at least for the board, we can show the trade-offs and the likelihood, and then ultimately that transfers over to the retirement boards who, kind of own that. Yeah. So they own it jointly with the General Assembly. Yeah.
Sam Watts, I'm the Director of the Retirement Systems Division. And I'll just embellish on what Kevin said, which is absolutely correct. The goal is 100% funding of the retirement systems. But because we have an ad hoc COLA, generally you want to have the possibility of overshooting on the investment side, because that's how you're going to ultimately pay for cost of living adjustments. I think more than at certain times. And that is the legislature's very clear policy preference and statements to us. They would prefer that we are paying for the cost of living adjustments out of the gains on the assets, not out of contributions removed from current taxpayers.
Yeah, that's helpful because from my experience in the state of Georgia years ago, we have two systems, teachers and employees. And our teachers fund, the COLA was automatically built into it. So they got an automatic COLA every year. Whereas on the employee side, it was more ad hoc. So as you can see, that created a little bit more drama in Georgia than it needed to be. So it's kind of good to hear what your philosophy is as pertains to that.
We value our ad hoc COLA because it gives us the ability to control, to ensure the stability of the finances of the system for the state. But we also value, we want to look after the best interests of the members, which generally is if we can provide the cost of living adjustment when warranted.
The employer contribution for teachers alone is accelerated from 12 or so a decade ago, it's over 17 today. And that acceleration is particularly acute for employing units.
Yeah.
It's as a result of the closed amortization period, a bunch of things, but it points to Kevin's point. Undue risk is really expensive in the system, even with ad hoc.
Yeah. The final thing I'll just reemphasize is what I like about the asset liability study approach is that all of these factors can get woven into some financial analysis, right? Which is, again, in a projections world, we can't, foresee the future. All we can do is analyze what we think the future will be, and then show the trade-offs. And because otherwise, I think it's easy for an investment organization in particular to say, give us a requirement, Okay, it's the actual assumed investment return, 6.5. All right, that's it. We're done. We'll go make that 6.5. But it doesn't take into account all the downstream effects. So if we don't earn a reasonable premium over that 6.5% over time, then you can't have the COLAs. You're less likely to be fully funded, right? But if we reach too much, then we run the risk of, in the short term, you get underfunded significantly, no COLAs, and contribution rates spike and the system may not be sustainable. So it really does need to come together kind of across all these different dimensions.
I think for those with sharp eyes, you'll note on 13, the peer comparison policy weights. Reminder that we changed the policy after. This is the old weighting. Policy changed in January.
All right. Matt, can you pull up the ORTEC presentation? And I'll go through that.
Stacy, Tom, you just want to tell me when to move?
Sure.
Thanks, perfect. Yeah, thank you for that introduction, and thank you for inviting us here today to talk about the economic scenarios for the ALM study. My name is Tom Heesenberg. I'm a senior ALM consultant at ORTEC, based in the Netherlands. I've been with the company for 11 years now. I'm joined here today by Stacey Howling, our managing director for US business, based in Atlanta. And online, we're joined also by Ben Hudson, actuary and senior ALM consultant based in the UK, working from our London office, and joined by Patrick Type, PhD in finance and the head of our economic scenario solutions. You may help answering some questions if there are any. Next slide, please. The purpose of today's meeting here is mostly to inform and discuss about the economic scenarios that are underlying to the ALM study, the methodology that we use, and how we model assets and macroeconomics that ultimately drive the capital market assumptions. It's for any ALM study, I think, absolutely crucial to have a good understanding of course, the assumptions that are being used, but also to make sure that there is that these assumptions align with your views and that they're well supported by the stakeholders. I can imagine that a lot of you are not very familiar with our company, ORTEC. Well, we have a strong footprint in Europe and in Canada. We're relatively new in the US, relatively unknown in the US. So start off with a quick introduction of the company itself. We're founded in the 80s by a group of students from the Erasmus University who started building models to optimize processes and later on also to create scenarios. We've always remained strong ties with the academic world. That has helped us to ensure that our models are founded and backed by strong foundations. And it's helped us also to remain innovative and come up with new solutions for our clients, ultimately with the goal to improve the decision-making process. We're an independent company, fully owned by the employees itself, and we don't sell any investment products. Next slide, please. Yeah, we have a number of solutions that we deliver to our clients, to our institutional clients especially. I won't go into details here for the sake of time, but what we do with our ALM studies is we use our software platform GLASS, an ALM model with an integrated economic scenario generator that we will discuss today. Next, please. We're a Dutch company, so we have a strong footprint in Europe, but we're also active in other regions of the world. We have offices in the Netherlands, the UK, Switzerland, Singapore, Australia, and Canada. And in the US, we work with clients such as TIAA, CalPERS, the UN Pension Fund, and a number of others. Thanks. Yeah, and then before we dive into the content itself, maybe on the next slide, quickly an overview of the ALM process itself. So like Kevin also explained, it starts with the assumptions and the objectives. Those are paramount to the success of an ALM study. Then it's critical that they're accepted and supported by the stakeholders. And if not, we can of course make changes to the assumptions. Once we are in agreement there, we can model them in our systems in class, and we can analyze the current status of the pension plan, everything going concern, given the current policies that are enacted. And this gives us a sense of, or we can present where we, given the set of assumptions, you may end up in 5, 10, or 20 years' time. What are the expectations? What are the expected risks? And we can also look at probabilities of being fully funded, probabilities of funding, of contributions being below, beyond a certain point, and volatilities. Once we've looked at the current status, we'll try to look at alternative policies, especially with respect to the investment strategy, to find policies that hopefully improve the outlook, whether that is in the central expectation or by reducing risks. And there we'll also make use of optimization techniques. Once we've found one or several candidate portfolios, we'll run sensitivity and stress testing analysis to together with you confirm the validity and robustness of these portfolios. Ultimately, of course, with the goal to be able to make a recommendation. So that's the overall process. On the next slide, we zoom in a little bit on the assumptions, and especially the block in the middle, which is the focus of today. So we'll zoom in on the methodology of the economic scenario generator, how we model assets, and ultimately the capital market assumptions. Got a lot of content, so I'm going to keep a quite high pace, but please do interrupt me if I can slow down a little bit. Next. Right, so an ALM study, at the heart of it is a projection of the balance sheet of the pension fund itself. So that starts for us with modeling the assets and the liabilities, and all the policies that govern it, regulations too. And that allows us to make a valuation, like you also do, of the full balance sheet. And then we take an economic projection. We can set assumptions on where perhaps the economy can go and financial markets a year from now, 2 years, 10 years from now. And that allows us to basically roll forward or simulate that balance sheet and to make evaluations a year, 10 years, 30 years into the future to see how the fund is performing. Now, of course, we don't know where financial markets and the economy is going to go. So we're not just going to make a single scenario or a single projection. We're going to make use of thousands of scenarios, economic scenarios. And that allows us to create a distribution of outcomes. And that means that each of these scenarios is going to be realistic and plausible, given a set of underlying methodologies and assumptions. And this enables us to look at the distribution of outcomes, at expectations, at risks, at probabilities, all in order to say something about where the funds may end up and how we can potentially improve policies. Now, in order to do this, we need stochastic scenarios. We need a set of scenarios, and that is what I'll discuss on the next slide, where we give a high-level overview of the methodological foundations of our scenario generator. There's a lot of information on this slide, but I'll start in the top left. Our projections start with the current market conditions. So we start at the current interest rate levels, current levels of inflations, current business cycle, etc. And we do that for 2 reasons. So one is to align with also the valuation of your assets and your liabilities, and to make sure that there's consistency between the two. But we also do this because there is some, because we believe that the current market situation also says something about the short-term economic and financial market circumstances. For instance, there is some stickiness in interest rates. If interest rates are 4 today, they're unlikely to be 7 tomorrow. And the same is for inflation and other risk drivers, or perhaps the economic cycles. And that brings me to the second part here, the stylized specs in the top right. The stickiness of interest rates and many other empirical laws that you can observe in historical data is what we try to capture in our economic projections, because that's what make our projections realistic and plausible. So we have a long list of what we call stylized specs that we model to make the projections realistic and plausible. So I already And I'll go into more detail on that on the next slide, but before we do so, I already explained a little bit that the current market conditions say something about where we may end up tomorrow or the day after, but it says very little about the ultra long-term projections. We're going to make projections here of 20 and 30 years into the future, which is far out from now. And for that horizon, we'll need a different approach. But for the ultra long term, we make use of a building block approach, where we basically set assumptions on underlying drivers, such as, for instance, for interest rates, we set assumptions on the short real rate, we set assumptions on a term spread, we set assumptions on inflation and inflation risk premium, ultimately to build a long nominal yield. So that allows us to make this transition from the current market conditions, modeling economic cycles, ultimately to go to this ultra long-term steady state. Our models are to a large extent data-driven, but there can always be events that are not captured yet by historical data. And that brings me to the last quarter here, the bottom left. So occasionally events can occur that are not yet present in historical data. And in those instances, we feel the need to apply an override, or what we call a view, on the pure model projection to incorporate that information. And an example of that is perhaps monetary quantitative easing that we saw after the great financial crisis, where central banks started buying up a lot of debt. And we knew, of course, that that was going to suppress interest rates. And that is then a view that we incorporate in our model on the short to medium term. Another example can be shocks from instance, kickoff of a trade war, or in the past, Brexit. So those four foundations combined are the base of our economic scenario generator. Zooming in a bit more on those stylized specs and why these are especially important. These are just 6 of them, maybe the most important ones, and for the sake of time, I'll cover the top 2. So to start with the term structure of risk and return. This basically explains how risk and returns are not static, how they can change over time, how these numbers are dependent on observation frequency. So to give an example there, for instance, if we look at the correlation between equities and inflation, we're going to be close to 0 on any regular day. However, if we observe the correlation between equity and inflation over a very long time period, say 30 years, you will actually find a positive correlation. So that is especially important if you have liabilities where perhaps you have ad hoc cost of living adjustments, and equities can actually help to hedge some of that inflation risk. So that's the kind of behavior that we want to have present in these scenarios. Similarly, on the top right, we have tail risk and correlations, with which we mean that any investor, of course, knows that it's important to have diversification in your portfolio to mitigate some risks. And we model those correlations between different regions, between different asset classes. But those correlations are also dependent on the economic circumstances. So, for instance, on a regular day, a regular month, you may see a correlation between equity US and equity Europe of, I don't know, 0.7 or something. But when markets plummet, and just when you need the diversification the most, you can find that these correlations shoot up to 2.9 or almost 1. So when you need this diversification benefit the most, it can basically cease to exist in certain circumstances, increasing tail risk. So how do we achieve these scenarios and these stylized specs? We make use of a factor model that enables us to capture both short-term, medium-term, and long-term economic behavior. And it also helps us to create consistency between different regions, between different asset classes, and between market economics. Now, we do all this, of course, to be able to consistently and realistically project out assets and liabilities. It's one consistent framework for both sides of the balance sheet, ultimately with the goal, of course, to improve decision making. As I explained, our projections start at the current state of the economy, and they trend to a long-term steady state. And that steady state is reached after about 25 years or so. It's not a point estimate, but there's also uncertainty around that. And I'll talk a bit more on that on the next slide. So our very long-term expectations, they're based around what we call a neutral worldview. That's probably up to debate, but that's how we look at it. We project positive growth, obviously, but lower than maybe you've seen historically. And the reason for that is that, well, we see a lot of technological progress that can drive productivity growth. There are also demographic headwinds that offset that to some extent. For inflation, we assume a long-term expectation of 2.25. That is just above the central bank, the Fed's target of 2.0% for personal consumption expenditures. We find that CPI is typically a little bit above that. And for long rates, we have an ultra-long assumption of 3.75. That's a little bit below current levels, obviously. In the projection, we'll see that for the next 10, 15 years, it will hover around 4%. Again, these are not point estimates, so there's a lot of uncertainty about these long-term assumptions, so we model those stochastically as well. And these are just the averages of those scenarios. Next, please.
Before we leave the inflation one, because that's obviously a big one and a topical one.
Yeah.
As I read this, it basically boils down to faith in the Federal Reserve.
Yeah.
Are there any other inputs that you think about in modeling your long-term inflation?
So for us, indeed, for these long-term assumptions on inflation, we look closely at the target of the central bank, of the Fed. We also look, however, at other research and institutions available. So we check our data with OECD statements or IMF. Occasionally, for certain regions, perhaps we make a different decision here. We feel that the central bank in a certain country is maybe not as strong as the Fed is in the US. But yeah, for us, for the very long term, the Fed's target is crucial. In the shorter term, of course, there are other dynamics that can drive inflation. Right now, of course, there's geopolitical risks. There is maybe upward fiscal spending that can drive up inflations in the short to medium term.
Reasonable amount of research out there about aggregate stock of governmental level debt and its impact on inflation in that country. Is that something that you guys attempt to think about or model? Or?
That's a good question. I'm not familiar with that research myself, but maybe I don't know if my colleague Patrick is on the line and can hear me, but then maybe he can comment on that. Patrick, are you there?
Yes, I'm on the line. So unfortunately, the part of the question dropped off. So if the person who asked the question would be so kind to repeat, then I'll be happy to take it up.
Sure. A lot of research around the aggregate stock of governmental debt and its impact on long-term inflation rates in that country, Japan being the obvious case. Is that something that you all think about as you model long-term U.S. inflation?
That is certainly something we think about. We are familiar with that literature. I think so far we have been comfortable with the assumption as Tom just set it out. We do monitor whether we see any reason to make changes. And as Tom might also elaborate on at some point, we could also envision ways of analyzing what if an assumption turns out differently to do stress testing on this type of thing. But for now, we do stand with our assumption as it is currently. But again, stress testing might be a way to deal with particular alternative outcomes.
Fair point. Thank you.
Can I ask a clarifying question? Like, what's the range of inflation over the long term in terms of what the model is generating?
Yeah, I can show you that later on. We have a slide on that projection actually, but I think the higher percentages go to about 10%. Maybe some that should over to even more extreme scenarios, 15%, but it's just going to be one or two. And on the lower end, you'll see negative inflations of a couple percent.
Hey, two other questions, and this may be in the eventual output of stress testing. Like, how sensitive is your model to, say, a 1% change? Let's say the 10 years 4.75 long term, instead of like how sensitive, and then how are you adjusting for changes in correlations between equities and bonds?
Yeah. So that sensitivity to the level of inflation is exactly what we can study with our models during the ALM study. So if that's a point of concern, we can run the same analysis with a higher assumption on inflation, and we can see how that impacts the projection, how that impacts the funding ratio or contributions. It probably won't directly materially affect the correlations. I don't know, Patrick, if there's anything that you'd like to add on that.
I think on the correlations, what might be useful to at least recognize is that the model generates different correlations in different circumstances. So for instance, what Tom mentioned, that if there is a crash in one region, maybe other regions might experience a crash also, so that the correlation effectively shoots up to 1. However, the model also incorporates flight to safety dynamics, where you might see a crash in one asset results in a run to another asset. So that would typically play out with this stock bond correlation. So we do capture such regime shifts, if you will. So yeah, maybe that also helps to further answer the question or the intent behind the question.
I appreciate. I think it's important. Like in these sorts of studies, most folks tend to assume a negative correlation between bonds and fixed income and flight to safety. But and that's been true in the last 40 years, but that's not necessarily true if you go back 100 years or 150 years. And so it's just
3 years.
Yeah, yes. So it's just important to be able to make sure we understand the different impacts.
Fully agree. And I think for our model in normal times over somewhat longer horizons, we would actually see, I think, a mildly positive correlation between stock and bond returns of 0.1. Whereas if you see a crash event, then it would go negative to reflect exactly this past experience. And then I think one thing that could lead to a conclusion of saying, well, how do you end up with others using such a negative correlation? Well, if you look at a sample that contains a crash, the flight to safety might be so pronounced that even over somewhat longer horizons, you would still find this negative correlation. But in our data analysis, we found that it might actually be more appropriate to, over longer horizons, use a mildly positive correlation between the two. That actually reflects similar worries we had to the ones that were just expressed by the asker of the question.
Thank you.
Okay. For the sake of time, I'm going to skip this slide, but it basically summarizes the building block approach that we discussed and summarizes the economic narrative that we covered. And on the next slides, so I've talked a lot about our methodology and shown you some numbers, but finally I get to show you a graph or a projection. So here you're looking at, and this is just an illustration, a projection of a typical pension fund. In orange, you see the distribution of the scenarios. So this is the investment portfolio. With the denser the orange color, the higher the density, the darker the orange color, the higher the density of the scenarios. Also, so then how more likely you are to end up there. So you can see it can go up to quite high percentages, but it can also be low growth or even reduction in monetary amounts. In green, we have the median projection, and then in blue is the realization. And the funny thing is that this projection starts just at the end of 2019, right before the pandemic started and financial markets crashed for a while. And you can see in that realization that indeed the blue line drops down significantly, and it actually ends up in the 1% probability of our projection. And that is, of course, whereabout you would expect such an event to be. After that, of course, markets rebound, the realization goes up again, and in the long term, you see that it is relatively close to the median projection. Just an illustration. Next. So that was the introduction on the economic scenarios. In this second section, I'll talk more about how we actually model the various asset classes starting, and we don't have the time to talk about all asset classes that we're going to model in this study, but I'll cover a few main groups. So I'll talk about fixed income, I'll talk about public equities, private equities, and private credits. So to start with fixed income, we generate the returns by simulating the underlying yield curves in combination with a specification of the remaining maturities, the coupons, and the principals of the bond portfolios. So that information combined drives then the total returns of the fixed income portfolio. And the reason that we take this approach is because it ensures consistency across different fixed income portfolios. How do we do this? We make use of a extended Nelson-Siegel yield curve model that allows us to graph different or changes in the shape of the yield curve, different dynamics and correlations across many yield curves simultaneously. For corporate credits, we have a similar approach, but in addition, we also simulate what we call remainder return. It's an excess return that captures the impact of rating migrations and default risk. Next, please. For public equities, we model these on a total return basis, and here we achieve consistency by regressing for different regions on the same underlying global factors. As a reminder, our model in essence is a factor-driven model. We distinguish between different types of equities, for instance, on cap level or volatility, and of course also regional or country differences. Yeah, like we talked about here, for the ultra long term, we use a building block approach for the returns for equities that consist out of real earning growth, inflation, and then payout. We use this building block for developed markets. Then for individual regions, we use a CAPM model and a beta with respect to the developed markets to get returns for the individual regions and different equity flavors. And lastly, so our model we're modeling here broad benchmarks. So our scenarios reflect a passive investment strategy. This is something that we can, something to be aware of. Of course, we can set different assumptions here if appropriate.
Right, and your building block for equities, are you using a exit multiple assumption also as the fourth component? Or are you assuming things stay the same?
Patrick, can you help me with this question?
Very happy to. So for equities, what we look at is we say the long-term expected return is driven by the carries or the payout yield, by real earnings growth. Then we want to make that nominal by adding inflation. And then in the end, so what we end up with is we have an assumption for the payout yield, so that's dividend yield plus repurchase yield. We have an assumption for real earnings growth, an assumption for inflation, and these combined lead to our equity return expectation in the long run. If you speak of exit multiples, you could look at what it would imply, but I think in that sense we don't look at multiples as such for our long-term framework because we prefer ourselves to build this up from the type of building blocks that I just mentioned. Even though a multiple could be an equally valid way to look at it, we chose this route.
So a static equity risk premium.
Static in the long run, dynamic over time.
Okay, next slide. Yeah, moving on to private equity, also modeled on a total return basis. We model different flavors of private equity, venture capital buyouts, and mezzanine investments. Because the data is, of course, appraisal-based, we apply an unsmoothing technique to remove strong autocorrelation and to reflect market risk, as we discussed earlier, to get a consistent trade-off also between private equity and other asset classes in the simulation. Our models represent broadly diversified investments So by nature, then also this kind of implies that we're modeling a median manager. Of course, you may feel differently about your private equity investments. So of course, there we can tailor to the specifics of your investments. We assume a beta relative to listed equities reflecting a similar cap level. Small cap. Next slide.
So maybe before we leave private equity, just put a fine point on it. Excess return observed in private equity, it sounds like is just excess beta in your view.
Sorry, can you repeat that?
Excess return in private equity over time is just excess beta.
Yeah.
There's no structural alpha to the private equity industry net of fees. And if you looked at this a decade ago, would you have made a different assumption about that?
We have always been quite conservative there. There's a lot of literature on the topic, and with mixed outcomes there. I don't know, Patrick, if you can maybe add some other thoughts on that.
Yeah, very, very happy to. So I think if you, at least the way we read the academic and practitioner literature, mainly the academic literature, we find it difficult to establish, in our view, a clear consensus in favor of structural alpha at the median manager level. So therefore, we decided we don't see sufficient evidence for us to have sufficient conviction to incorporate this in our standard assumptions. Now we do see that a number of clients have, as part of their investment beliefs, the conviction that they invest, say, in top quartile managers. And then, as Tom said, we're happy to reflect that in the assumptions that are used. So as we serve many clients across markets and geographies, etc., we decided to go for an assumption that we could stand for at the median manager level or at the overall, say, market level. And this is what we ended up with. And I think that has not changed the past 10 years. I think our assessment is the same. Our main adjustment to the assumptions the past years has been that now we do reflect the typical cap level in the sense that private equity tends to have smaller cap levels than typical large cap benchmarks that people used to look at previously. So we did reflect that, resulting in this additional beta that you referred to.
Cheating. Looking at page 25, it definitely would look like buyout. And we don't want to look at 25, I just cheating. But it does look like buyout doesn't get like real return premium. And as Brad said, it's kind of explained by maybe a higher beta to small caps, which themselves probably have a higher beta to the AQUI. But in venture, there's 300 basis points of excess return expected. Is that also explained by beta, or is there an alpha assumption there?
There's no alpha assumption. Sorry, Patrick, maybe you can best answer that.
Yeah, very, very happy to take it. I'm just looking at, so then I think we're looking at this. So the way we look at the excess return is in terms of geometric return, and then the arithmetic return follows because the volatility for VC is different in our assumptions. So therefore, the arithmetic needs to be higher if the geometric is the same. So this is, I think, the 300 basis points that you referred to is a consequence of us using the geometric as the basis for our assumptions.
Yeah. Okay. Makes sense.
If I could try to add a fine point and not confuse things. So the way I think about this is for these individual asset classes like private equity and then the subcomponents, essentially what's being assumed is we reach into an urn, we pull out a random venture capital fund. We do that sufficient times, then the average of those ultimate returns are going to be 11.3%, right, over year 1 through 10. We pull that out, that's on a standalone basis. We do that for other asset classes, including real estate, infrastructure, and so on. They all have that arithmetic return that's in that column. Then you blend them together and you get diversification effects to the extent there are some. And then what we care about is not so much that arithmetic return. We care about the blend and the compounding over time, and that's the geometric return. So it's a little wonky, but the arithmetic return is a very simple assumption about, we're just looking and without any insight or comparative advantages as an investor, we're just grabbing random funds. If ultimately the view is we might have an edge through various reasons, like co-investments, size, better fees, then maybe we can, if the board is comfortable, we can bump up that assumption a little bit. But again, then that becomes a bit more speculative, frankly. And but that's the idea of looking at the arithmetic on a standalone basis and then look at geometric for the total plan, because that's what we actually will post after all the diversification effects. So anyways, that's the way I think about it.
I guess what I worry about is that the observed illiquidity premium in buyouts has declined structurally over 40 years. And we're hard coding an assumption that it no longer declines from here.
And I think to a large extent also we don't directly model that illiquidity premium.
Right, it's excess beta.
Yeah. So for us, basically there's the implicit assumption that it nets out against fees, because these returns are all net of fees.
Although technically it is declining in their assumptions, right? So if you look at 8.1 minus 7.5, that's over the 10 years. That's the premium to buyout, which are pretty narrow. And then over the long term, it actually declines a bit. Then again, we can always pull out scenarios and then stress test, for a given allocation to private equity, and that spread narrows or turns negative. What's the overall impact? We can look at the trade-offs.
Yeah, slide 21. Private credit. Here we use a similar approach as with corporate credits, so a spread-based approach. But of course here we model a floating rate product with a slightly higher recovery rate versus high yield corporate credits. A lot of different flavors here of private debt, private credit that we can model, ranging from direct lending, leveraged loans, infrastructure debt, and to structured products. Average maturity is typically a bit lower than what we see with public debts. So that slowly now brings us to the numbers, to the capital market assumptions, which we already got a sneak preview. Crucial aspect to it is that they're in balance with one another, that we have one consistent set of numbers to get a fair trade-off between these different asset classes once we start running optimizations, such that we get a fair projection there. We simulate scenarios, so basically we can present these numbers for any time horizon. We're showing 10 and 30 years, but we can also, if you're interested in that, pull up the numbers for a 1 year or a 25-year horizon. And calculate the statistics over that. So there's flexibility there. And finally, as I already said at the beginning, it's important that these numbers that we're going to show is first of all just a snapshot of all the asset classes that we do model. It's not yet tailored to your investments. We will do that later on in the process, obviously. But it's also important that this is just the Arctic Finance house view. If you have a different view, if you are not comfortable with these numbers, then of course, we can make adjustments to that, because it's ultimately crucial for the success of the study that the numbers are supported by. On the next slide, I'll just say that this is the projection for the end of June 2025. Returns that we're going to look at are net of fees and representing a passive investment strategy in the median. And then I think we can go to the table. So there's a lot of numbers on here. Like we discussed, we're showing arithmetic and geometric returns on a 10 and 30-year horizon, as well as the volatility for a subset of asset classes. And I'll pause it for a moment to give everyone the opportunity to read the table, see if there are any questions.
Underneath some of these, there's a lot of detail. So U.S. government bonds, for instance, the entire yield curve is modeled. And so we're able to do the modeling within the Ortex system of moving away from our current longer duration than market to shorter duration or customized buckets of duration. The model is particularly, I think, powerful in that sense. And likewise on the investment grade corporate, there's lots of flexibility to do that kind of modeling and not just take for granted that we're going to keep our traditionally longer duration in the market.
Are there any questions? If not, then we can continue to the next slide.
Might one actually. So I'm gonna look at the difference in the return data, assuming that the modeling is that the major compression we have in IG credit spreads is modeled to resume back to a more normal level, and thus the compressed difference between corporates and governments.
Yeah, so indeed, we model, so for these corporate credits, we model the underlying risk-free rate or the treasury rate, and then on top of that, a spread. And that has moved, and in our model, that will indeed normalize again. And that is what is reflected here in these returns. Yeah. Okay, 2 more slides. Show you the projection of inflation and treasury. So starting with inflation, we can see that it starts at the current levels of somewhat above 2%. It jumps up a bit higher actually in the first year, driven by geopolitics and anticipated upward spending. But in the long term, it returns to its long-term target of just above 2%. Both CPI and wage inflation are modeled stochastically. For real wage growth, we have looked at the whole of the US and arrived at an average real wage growth of 0%. That is quite a sweeping assumption. Obviously, this may be different for North Carolina or your employees, so there's also room to take. And as you can see here on this slide, in worst case scenarios, inflation can go up in the 95% interval up to around 10% and down to -2%. There are some even more extreme scenarios if we would look at the minimum maximum, but this is roughly the range that we will see in the study, with the great majority of the scenarios ranging between 0 and 4%. Then on the next slide, a similar graph, but for interest rates. This is the 10-year treasury yield, and we're starting at the end of June level of 4.4%. In this projection, we're staying around to somewhat above 4% for quite a long period of time, driven by also that higher inflation level that we're going to see in the medium term. In the very long term, this will trend downwards to on average 3.75%, in line with the building block approach that we discussed earlier. And that was the final piece of information I wanted to share with you. Any questions, I'm happy to take.
Jamie or Lance, anything? All right, hearing nothing. Thank you very much. Appreciate it.
Thank you.
Thank you for having us.
Can I ask one quick? Sorry.
You're ahead or you're behind.
Just want to see if how fast we get up to
Just
these.
throw curveballs. No, I feel like it is a hard job. I'm curious, like, you guys find this harder than ever? or is it as hard as it always is?
That's an interesting question. So I do think it seems that volatility is increasing, or the change itself is going more rapid. It makes it challenging. A lot is happening in the world to events that we need to adjust to quickly. Extreme inflation or trade war dynamics, and we try to get that into our model, especially on the shorter term, obviously, and that can be quite challenging. There we need to act quick. So yes, that does make it more challenging. At the same time, a lot of our studies are over a very long time period, 10, 20, 30 years time. And then all the news of today is maybe a little bit less relevant. So it obviously has an impact on the shorter term, but it's more dampened on that very long term. So I feel that we can still do our job in somewhat the same way as we did maybe 5 or 10 years ago.
Yeah, because you'd said that this is kind of predicated somewhat on a independent and competent Fed, but it's also predicated probably on continued linear technological progress, not exponential progress, which I think is probably a good base case assumption, but it does seem like the tails and the fan of outcomes is wider. It probably always feels that that's true. That's why I asked the question, but
yeah,
it actually feels like it's true.
So we update our models to review a lot of our assumptions on an annual basis, and for specific pieces of it, we revamp them or we do larger overhauls when we feel it's necessary. For instance, a couple of years ago, we've completely changed our inflation model to incorporate new technologies, but also new information or new historical data, new views. And that's, I think, the moments where we indeed can incorporate these kind of views and then maybe see a bit more volatility or more skewed distribution of outcomes. Yeah.
We also do respond to short-term events by doing a lot of our own research and that we publish and disseminate to clients. That's part of kind of our partnership too, is to make sure that you sort of stay in line with our way of thinking. So for example, on the trade wars, we immediately had white papers out, webinars, and meetings so that our clients who are experiencing our consulting or using our scenarios could see kind of how our line is thinking and how things are trending for us. So we try very hard to, from the short-term events, to be very transparent with our clients about how we're thinking about things and sharing the kind of academic research. And that's part of the benefit of having an academic background. I think most technology or consulting companies don't put out as much research as probably we do, but that's available if anybody wants it.
Thanks.
Thanks.
Thank you very much.
Thank you.
Thank you, Ryan.
One other comment while the RVK folks are coming up. Yep, there they are. I think also for context, for many years, the concept was do these studies and focus on the 30-year horizon and have really rigid strategic asset allocation and bands around that. And then you have your buckets and you fill them. You just try to be as close as you can to your targets. I think as we've learned over time, that's suboptimal. And so I see this as like establishing some guideposts. And then what we'll need to settle on is over time, how much flexibility do we have? I think for the investment program to be most effective for the ultimate beneficiaries, we need more flexibility. So if there's large sectors of the market that are either dislocated, neglected, so there's available risk premium, we can lean into that. And I'll have a couple comments about that later in the performance presentation. So we still want to be very cognizant of these big picture trade-offs, but as markets move or technology changes in ways that maybe the models can't anticipate, it's our job to do that in real time. And always look for those opportunities to kind of add additional value, take risk down, or maybe take risk up slightly to get better returns. So I think that's ultimately, this will be some guideposts coming out of the study, and then the real fun stuff is going to be figuring out how much flexibility and where do we have that flexibility with the new board. That's my sense. So now we're going to have the presentation from RBK. Do you all want to introduce yourselves and go right into the presentation?
Certainly. I think we have Jim Boyko on the line, but he was having trouble connecting. So Jim, are you there?
I am. I hope you can hear me.
I'll start. I'm Marcia Beard. I'm a senior consultant at RVK. I'm out of the Portland office, which is our home office. I've been with the firm. Last month, our former CEO wrote me a note and said I would, happy anniversary. It was my 29th year at RVK. Prior to that, I sat on your side of the table. I was a client. So we're happy to be here, and thank you for the opportunity.
Well, since I'm the other person here in person, I'm Jason Szymanski. Very nice to meet everyone. Very nice to see some of you in person. I'm actually out of the New York City office, even though I've spent the bulk of my life living in Los Angeles. I've recently joined RVK about 3.5 years ago. But I have close to 20 years of industry experience. Mostly that experience has been working with large, complex, sophisticated public defined benefit plans, very similar to the one we're going to be discussing here. We're also joined virtually, who would have loved to make the trip but wasn't able to because of another client committee, our head of our IPR investment practice review, Jim Boyko, who's here online.
Would you like me to introduce myself?
Yeah.
Yes.
Is that a yes?
Yes.
Okay. I'm Jim Voitko. I've been at RVK for 21 years. I've been in institutional investing and capital markets for over 40 years. So I'm the old guy in the room. I've been on your side of the table as a CIO, as an executive director on the buy side, on the asset management side. I've been a research director. I've been a trustee as well. So, but now the last 21 years, I've been a senior consultant, and along with Marcia and many of our colleagues that work with us, we work on the investment program review practice. So I'll stop there.
Jim, do you want to start us off, or do you want, were you planning to do the intro, or do you want?
Yeah, let me just give 2 or 3 minutes if I could, Marcia, and that is, it relates to the timing of this review. It's unusual timing because it was at the cusp of a very significant and what we view as a very positive change in the governance structure for the funds, but also the statutory framework in which the investment program must operate, and as well the organization and delegation of authority and resourcing of the program itself. As I said, we view these changes as very positive and quite significant. And sitting at the cusp, we asked ourselves, should we be looking backward at a program that's undergoing significant change, or should we be speculating about how that change should be implemented? So we decided that our scope of work is a backward-looking review of the program as it was. So we did exactly that. But we spent some considerable amount of time looking at aspects of the program that we're reviewing in the years that it operated that have implications or relevance to what the new board and the staff at North Carolina is going to do going forward. So with that, I wanted to turn it over to Jason and to Marcia to carry the bulk of the presentation. So I'll stop there.
And quite frankly, we were excited about the changes that you're facing, and it was hard to bring us back to looking in the rearview mirror. With that said, you know, reviewing the organization, reviewing the investment program, we don't anticipate a lot of that's going to change. So it actually was quite helpful for us to look at your processes, your rules, all of that, because that will continue on. So with that, I'm going to start. We have lots of recommendations, but we're not going to go through all those. We're just going to hit a few highlights. Under section 1, this was the reviewing the current authority, duties, and laws. I want to say up front that we found that the statutes governing the retirement system investment program are well-founded. They're reasonable and they're in line with other public pension plan laws in other states. So with that said, we thought that was great. The statutes pertaining to governance and authority do not reflect common practice, as you well know, and you are making those changes. Also part of the scope, we were asked to advise on provisions that could impede the ability for the investment management division to carry out its functions. We broke this into the authority, duties, and laws, and under authority, certainly it was the sole fiduciary. It's just a big job for one person. You know, that person could change every 4 years. It hasn't, but it could. So there are a lot of headwinds to that. And managing assets of a public pension plan has gotten far more complex over the years with alternative assets, as you have listened to today. Also under that authority, just the Investment Advisory Committee, again, best practice is to have a committee that is diverse by experience, diverse by selection, and expertise and by background. So you've also handled that with the new board that I guess we'll be meeting today, correct? There's a third that we put, but I'm going to address that in one of the recommendations that we'll review on in the investment policy. As far as duties, the statutes governing the retirement system investment program are similar, again, to other states. They follow common trust law, fiduciary principles, and the Uniform Prudent Investment Act. So good there. As far as laws, the state treasurer is subject to a detailed and thorough reporting requirements, and that's in statute as well. Oversight is good, and based on our review, we were able to confirm that the state treasurer's compliance with those mandated reports were in compliance with the mandated reports. What we weren't able to do is see what happens after they leave the investment management division. Who reviews them? Do they provide a checks and balance? But the investment management division and the treasurer were in compliance from our review of the statutes. Second on laws is that North Carolina is unique in having statutes mandating how you can invest money. The legal list, which is statutory, limits a plan's ability to invest in certain securities or asset segments. Our recommendation, as I think your prior review stated, that we believe these restrictions should be removed. It conflicts with Uniform Prudent Investor Act and is contrary to diversification language that you actually have in statute. So that is a recommendation. The next section is policy and process. I'll cover the investment policy and do a couple of recommendations. North Carolina requires an investment policy statement. Some states don't. I think most state public pension plans do, but you do have a policy statement, and the treasurer is required to present that to the committee biannually. The IPS serves as a roadmap for investment programs, and the components that you have in your investment policy are common industry best practices, and they allow you to provide fiduciary oversight for the investment program. The investment policy is organized in 9 sections. Our recommendations follow those sections. We're happy to answer any questions about the recommendations, but we're going to just hit on a few of them. Here on roles and responsibility, we think it's very important to clarify ownership of duties, and we believe that Section 2 of the investment policy could be expanded to include general counsel, custodial bank, investment managers, consultants, et cetera, other third parties that have a role that is played with the investment program. So we would put that in investment policy. The second recommendation is on the next page, And in our review of the documents, we saw that the management division's investment committee has been around since 2014. And the scope and oversight due to the scope and oversight of that committee, we believe it should be acknowledged under Section 2 as well. It plays a very large role. The next recommendation I'm going to cover is on page 15, and this is under risk management and controls. The state treasurer, looking back, has the ability to override strategic asset allocation ranges. The strategic asset allocation is reviewed annually by you, but the assumptions are long-term. You just heard that with the presentation regarding asset liability. We believe that keeping strategic asset allocation targets within the stated IPS ranges is crucial to meeting the desired level of risk and return to meet your long-term objectives. So we would remove that from the policy that says that the allocation ranges can be breached. We believe this is a governance issue, and any breach of those long-term ranges should be escalated to the investment authority, which is now the board of directors of the North Carolina Investment Authority. So a breach should be escalated. That's our recommendation. And we believe that number 3 under risk management could be removed from the investment policy.
Hey, can I ask you a quick question? What is the general, less specific to us, but what is the general RVK philosophy as it relates to investment policy statements on flexibility versus rigidity? Because I know there's very different people have different approaches. I'm just curious how you guys come at it.
We believe that again, as I said, it's the roadmap. It should be followed. If you have flexibility, you don't want a license to not follow the investment policy, right? So that's where we believe that the investment authority, any policy breach, the investment authority should be aware of, and then that's the board's decision.
Yeah, I'll add to Marcia's comments that if we agree, we heard your chief investment officer talk about the importance of a certain amount of flexibility along the pathway over time for investing, and we believe in that as well. But the investment policy should have a great deal of clarity in it about exactly what that means and how it's executed and what its boundaries might be. And there's several ways to skin the cat here. Sometimes IPs have that embedded in their rebalancing rules. Sometimes they have it embedded in delegation of authority within rebalancing, what we would call policy limits. But in the best investment policies are clear about how that flexibility is to be executed and who executes it and what its limits are. I hope that sounds reasonable to you.
And the ranges shouldn't be so tight. I mean, the ranges should be broad enough that you allow your investment management division to have some flexibility.
Yeah, thank you.
That's a question on this one. Andy Hoffman, IMD. We're going to have fairly rigid rebalancing requirements, while at the same time we're acknowledging in this session and part of our analysis is that we have a lot of asset classes that suffer from appraisal smoothing and lag, but yet we're rebalancing based on reported returns on a real-time basis. How do we take into consideration that factor?
Jim, do you want to take that one? I don't know that.
Well, there are several ways to address. I think what your question is how do you adjust in real time when some valuations are as much as a quarter old? And I think that you don't have a choice if you don't have mark-to-market values across your portfolio. You have to do the best you can. So when the limits are approached and potentially breached that are in the IP in the public parts of the portfolio that are marked to market, that's pretty straightforward. When you're lagging, you have to deal with them the best you can. In most cases, the lags are not a problem unless there has been some big movement in the public markets. 2022 was an example, and in that case, this is when the board as a whole has the ability, and many boards did during 2022, to temporarily rebalance or and essentially allow the denominator effect to be in place for a while, provided that the staff and the board agree on a plan to bring it back into policy. Because as time goes on, those non-mark-to-market asset classes do become more visible in terms of their actual values. I hope that's responsive to you.
So judgment and also we're not saying that you can't, it just has to be elevated. So your investment authority is aware that you've breached, and if there's a good reason, I mean, just so they are aware and if you've elevated that up.
It's hard to set the ban knowing that that issue exists.
We have clients that, some clients that were slower funding into alternative investments. And in this case, it's a sovereign wealth fund, and they have a lot of money coming in from natural resources. They have set interim targets for that very reason, because they can't get to their target. They set the target, but they know they can't get there quickly.
So I think the fundamental issue on this particular recommendation is in the new governance structure, the board will give certain delegations and will retain certain authorities. So if we were to ever want to go outside, or the markets pushed us outside of our strategic asset allocation ranges, which the board would approve, that should come to the board for a informed kind of fiduciary based decision as to whether the program should stay outside the bounds or come back in. And so I know many plans in 2022 had this issue where both equities and bonds fell massively, and then some of the alternatives got pushed outside of their tolerance ranges or their strategic asset allocation ranges. So you can approach that mechanically and say, make it go away, or you can say, well, maybe there's good reasons why some of those asset classes outperformed in that particular environment, in which case maybe from a fiduciary standpoint, you stay the course and accept the risk. Other cases, you say, no, we need to take down the risk given the circumstances of the plan. But I think in the new governance structure, that is one of the main reasons why this governance structure is adopted and was supported by the General Assembly and the governor. It shouldn't just be dealt with at the treasurer's level. It should go up to this higher authority where you get all those different perspectives on what can be a fairly complex decision.
So in looking back,
that the lag in valuation is a secondary complication to that judgment. The real problem is the illiquidity of those assets versus the public assets. That's the central problem in the rebalancing back toward the policy portfolio at heart. The valuation lag and differential in timing is sort of an additional complication. I'll stop there.
I only have one other recommendation in investment policy that I wanted to point out or discuss. Your IPS states, and this is under benchmarking and reporting, so the following page, and it's a second recommendation. The IPS states that the role in the portfolio, in quotes, categories are the foundation of the strategic asset allocation. Our recommendation is to create a role in the portfolio benchmark using broad benchmarks for each of those categories. Or it's kind of a thematic benchmark. the purpose of the asset class. We just think it would be another helpful benchmark for you to have in your portfolio, especially since you're basing your strategic asset allocation on that role in the portfolio. With that, I'm done with investment policy unless you have any questions.
I've got one question to go back to the legal list. How many states are still using that? Because most have been fortunate enough to get away from that. I understand there are constraints here in North Carolina and a few other states, but it seems like the General Assembly here is providing some flexibility around that. But is that still relatively common?
I don't have a number for you, but I can tell you I don't work with any. I work with large public funds as well, and I don't have any clients that have a legal list requirement. Do you, Jason?
You know, in my past life, I did. And I think about, I know New York State was brought up. So New York City is one that has what was known as and you're nodding your head, so the basket clause, where they restricted how much you could have in U.S. equities, non-U.S. It was this really convoluted formula that they had 5 different boards, 5 different consultants. Everyone had a different methodology in terms of how they calculated it. And a lot of times you were somewhat saying, I'm 90% sure I calculated that we're under the basket clause. And it would come back and say, no, we think we're right at or just a little bit over. Most states have looked at their legal list and to your point have said, look, it's either convoluted, it's outdated, it doesn't lead to ultimate asset allocation decisions. And I can think of more states that have actually moved away from them than ones that currently have them. But they still, you know, a handful still exist. And why they still exist is they were coded into law at some point, and the legislators are busy people. And so it's not of the utmost importance. What we are seeing and what we are also hearing is, again, it is becoming more of the utmost importance. Part of the reason why it's taken on a greater area of focus over the past few years. And so my expectation is, again, that in my sense is there's about a handful of states that still have them. I would imagine 10 to 15 years, those handful of states, maybe it's in the single digits at that point.
Well, we did some work in helping Alaska move to the prudent investor rule and remove such restrictions. We did the same thing with New Mexico. Jason referenced New York City. The New York State is actually one of our clients, and they still have a basket clause. But even there, we worked with them to go to the legislature, and the basket was significantly expanded and became less restrictive. So this is legal lists per se are a fading element of investment. The prudent investor rule and its diversification mindset has really taken over institutional investing. But as Jason said, there are a few legacy aspects that are still hanging on. I believe Michigan still has one, but they're fading quite quickly. So I'll stop there.
I'll quickly review. So if you were to look at the core topics for the scope, there's really 4 of them. The first one that Marcia just detailed was the current authority, duties, and law. The second one, as we touched upon with the investment policy statement, was the policies and process review. And in that second one, there were 2 other policies that we were asked to look at. We also looked at the third. So the 2 we were asked to look at was the investment management division, the investment manager and vehicle monitoring policy, as well as the investment management division external investment manager and vehicle selection policy and procedures. And besides those 2, because those 2 really monitor in terms of how you choose and how you monitor both your private investments as well as your traditional investments, we also want to look at the decision making, which, as we're all aware of, is radically changing. And so we also took a look at the IMD charter as well, which is listed within these pages. Really, the theme of the rest of this section is, again, as you start looking through these policies, be cognizant that, again, they still reference, in some cases, the treasurer as the sole authority and fiduciary party, that these policies will need to be updated, again, as you move further down implementation of the Modernization Act. We also kind of noted, again, especially in the IMD Investment Committee Charter, which is in here now, and that's gone fairly significant changes over the past few years. When you start looking at some of the authorities and rules and responsibilities, it didn't quite match up either in terms of the duration of when an item needs to be looked at versus some of the other underlying policies. My sense in talking to members of the IMD investment team was, again, at times they weren't necessarily looked at comprehensively. They were more looked at in siloed. And again, knowing that they also have a full-time pension to run and manage, our view and recommendation would be, once this is fully implemented, to go back and do a clean look at each of these underlying policies. But when we look at these policies and procedures overall, again, in terms of areas that we could potentially pick apart or make recommendations for, there really wasn't any. Most of these are reviewed annually. Most of them have gone significant version changes. All of them kind of listed the changes that have been made in the past. And again, when we start comparing them, especially the peers of the North Carolina size, they were all in line and provided enough flexibility, but also provided enough roadblocks and constraints that, again, if someone really wanted to go outside the bounds, they wouldn't be able to without notification, either from the CIO or from the fiduciaries at the time we looked at it, was the current treasurer. The third area that we looked at was the compliance process review. And this compliance process review mostly related to the internal trading of the fixed income and the equity portfolios. It also looked at private market investment activities. The three areas that we wanted to look at, and we really focused most of our attention within the internal portfolios. And the reason why is, again, if you look in terms of the degree of enterprise risk, internal trading is one, similar to the question we got before, where 20 years ago, I could probably rattle off 10 plus plans that were doing internal trading. At this point, a lot of them have moved away from it. And those that haven't moved away from it have put significant additional processes and segmentation of responsibilities and duties in order to ensure, even though these portfolios are pretty simple to trade, that again, that a trade error doesn't occur, a transcription error doesn't occur, that security doesn't remain out of settlement for a large period of time. When we discussed with staff and we looked through the policies and processes, again, in terms of how things lined up, they really lined up in terms of what your peers are doing. The one area where it seemed like you were a little bit out of step, especially compared to some of your peers, is again, the traders and the portfolios managers and the compliance department here kind of wears multiple hats throughout the trade life cycle. Or again, the goal, and most of the time you get what's known as straight through processing, where there isn't a lot of human intervention. But again, if there is human intervention, there could be multiple people who are potentially touching that trade. What we've seen is more of move to further segment responsibilities, especially as it relates to internal trading or any trading from a portfolio manager to an endowment and foundation that does its own trading. In talking to the CIO and his team, we know that is an initiative. It's an initiative that our predecessor did the last review, pointed out. It's one that we've also pointed out. It was one that was mentioned that is also in line for further discussion down the road, especially as you look at the resources of the overall organization. It's one that we would recommend that is near the top of your list, maybe not at the very top of the list, but is one that, again, should discuss further merit and consideration down the line. Because again, if you were to look at areas in terms of where there is risk, internal trading is one that tends to be near the top part of the list. The fourth area that we were asked to look at was the transparency, accountability, as well as the various ethics policies of the program. There's quite a few reports. We discussed it with staff. We looked at what's available, quite a few of them. All these mentioned on the screen here are also publicly available. And again, you want to have comfort that the public has enough information that, again, when things don't go the direction you think it's going to be, that there was adequate due diligence, there was adequate ethical walls, and there was adequate considerations. So again, at times when things kind of move against you, they can say, look, the process was sound. Here, again, in terms of your transparencies, the amount of oversight, the amount of overview, you are near the best of the class in terms of ones that I've seen in my current role as well as my past role. And also when we did additional digging into the other reports we have done in the past with large pension funds. So this is one area where, again, you do deserve tremendous applause in terms of the amount of transparency and the amount of ethical practices you put within the program. Large and short, again, we do have a larger presentation, which I believe was provided to you. If there's any questions regarding those four scope areas, we're happy to address them. You know, we understand that you are going through quite a bit of change, talking to staff, and we do applaud them and thank them for their participation, their willingness, their candor, their openness when we did spend time with them. And we look forward in the future, again, to seeing how things evolve. I know everyone we talked to spoke very appreciatively and was very much looking forward to the future state. We are too, and we will continue to kind of look to see how things are doing. And again, if you do need us to kind of look at things in the future, we are happy to do so too.
Thank you.
Thank you, Jason. Yeah, I would add a closing comment from my perspective, and that is that the resourcing or the re-resourcing that's going on is a necessary and very positive complement to the changes in statute and the governance structure and so on. When one of the things that most impressed our team, all three of us, is that even during a period where resources seem to be quite low when matched against the task that North Carolina has set for its institutional funds, the complexity and the size of them, the staff really did a great job in trying to adhere with the resources they had at hand to the best protocols that were in place during this period. And they should be applauded for that. And I think that the state and the legislature and the executive branch that is providing resources to actually build an organization that is well matched to the task at hand, which is the management of these large and complex funds, is also to be applauded. So we came away with both of those reactions. So I'll stop there.
Thank you.
I've got one more.
Good.
Observation or question. So I think the treasurer's done a great job. As we look forward and transition to the board structure, the treasurer's done a good job sort of identifying the number of board members and the criteria to be used for individuals to be placed on these boards. But I wanted to see if you could take a minute and just give an overall, your overall perspective on boards and the public funds area these days, because they are becoming a lot more partisan political, such as Ohio Stirs, and just to name one, but some of the others are becoming, moving in that direction. So I think people need to be aware of it, that even though we're moving to a board structure and seem to have the right sort of structure in place to protect North Carolina from some of this, it's helpful to know what's going on in the industry from a board standpoint.
Is that a question for RVK or for the treasurer?
That's for RVK, and Jim, you should start since you know Ohio well, but I have some comments as well.
Yeah, I'll start. We are actually the consultant to the Ohio State Legislature and their official body that oversees the pension plans, which is the Ohio Pension Council. And we have, by the way, we have the same function in Oklahoma, which Jason leads. As public pension plans mature, and liabilities grow over time because of all the things that you heard about in aspects of your asset liability study, it puts strains on the board with respect to differences in incentives and interests between retirees, active members, taxpayers, elected officials, and so on. So you're correct. Board composition is becoming a more challenging issue, and there are many ways to skin a cat. We're the consultant to the state of Vermont, which we helped several years ago and worked with the legislature to compose a board of investment that is very similar to what the treasurer has led here in North Carolina. So that there's no sort of perfect optimal board composition, but there are ones that are lean heavily toward one constituency or another, and they typically will at some point cause strife to emerge in one way or another. So that's the best I can say. Jason and Marcia may have additional comments.
I would say it's part of my job I love the most, working with boards and committees, but it's the hardest part of the job, especially with public funds because they change. You do have politics involved, but the behavioral part is very interesting. And also the turnover, you almost start over. Governance changes, sometimes not to the advantage of the members when there's a change. But that's also a challenge that we I don't want to say embrace by any means, but we take on that challenge and do our best to educate and do our best to bring them back to working as a team. And I have seen in recent, more partisan, just getting people to work together to make the right decision is, it's a challenge sometimes. I don't know how I wish I could say there was one answer, but every committee is different and changes all the time.
And in some respects, the choices about composition are really above the consultant's pay grade. We can give examples of choices that other states have made and how they've worked out. But we have to be humble and understand that we're not political advisors, and these are choices that are made well above our pay grade. So I'll stop there.
Yeah, I'll just end with one comment that, again, the one thing I've always viewed with public plans, they continue to evolve. So again, you may put a governance practice in place one day with certain board members one day, and it makes sense when you do it. You say, we did it for this reason. But similar to any team, at times you need to say, we've grown, we need to change the board structure. And my parents are actually both Ohio teachers, and so they have been acutely aware of what's going on there. They have also been very displeased in terms of the lack of COLAs coming from Ohio teachers. And so when things do not go well, and it starts going down to the participant level, people start paying even more attention to it. And as I've told clients, especially public plans, again, think about where you are today, but realize again that who's advising you today very well may change in terms of who's advising you in the future. So in terms of your question, it's one that you constantly need to be aware of, and one that, again, will require, again, just constant monitoring within the board itself. The ones I've seen who do it well are ones that have board offsites where they do internal as well as bring in outside experts to kind of help them walk through either their process making, their decision making, or some element where they feel that they're lacking in resources.
Well, I guess part of the point was to compliment the treasurer, because I think he's been very thoughtful in his approach to the number of board members, the backgrounds of the individuals who will be going on boards, because in many public funds organizations, the criteria is very limited, and you have a lot of people who don't have experience with pension funds or investments serving on these boards, and then therefore they can become a little more partisan and political down the road. So
We agree. Thank you.
Yeah, I think that's a good note to end it. So again, thank you very much to everyone.
Okay, we're right on time. Look at that. Let's go over to Jeff Smith.
Oh.
Charge.
No.
Yours is yours. Yeah, you guys. In the hot seat. I thought there might be a ejector seat on here. Or a zip tie.
All right, good morning. Are we going to take a break or anything, or? Good. Perfect. Good morning. We're going to chat a little bit about the investment grade fixed income program. On the second slide there, really try and cover a couple of things. Cover the cash management program or our STIF portfolio, the structure of IG fixed, a little bit of market color mixed in, and then a little bit of color on kind of the management strategies we employ and how we do what we do over time. Everything really starts with the people, on the team at the end of the day. And you can see the members here. Currently, we have 5 members there. And I listed on there just the number of years they've been with IMD for number one. And with the exception of me, the rest of them also had experience when they came in the door here to join IMD as well before. But I think that the numbers really point, and you'll see the returns and stuff later on. Really, the plans really benefit from stability over the decades of the team. I've certainly benefited from that from a leadership perspective to have the team together as long as we have. So myself and Brett Hall, and I believe Reka got over here. She does our short-term. Reka's in the back as well too, and Mike and put your hands up if you want there. Mike and Carlene on the credit research side. So Reka's the newest member on our team. She actually was with investments before she joined Fixed, and also with the department before that as well too. So she's kind of the newest member of the group, and we had another longtime member that retired last year. So a lot of continuity, and then we have one vacancy Kevin mentioned that we're recruiting for to expand our, I jokingly say expand our credit research team by 50% by adding one person. So we're in process on that. I'll let Brett talk a little bit about the short-term fund.
Sure. So we'll kick it off looking at the quarterly one-pager we provide our STIF participants. So draw your attention to the bar charts on the left. You'll notice that for the last 12 months that the STIF rate has been kind of in the high 4% area, moving more towards the right. You'll notice that we've kind of begun to drift a little bit lower. So the current STIF rate is 4.54. And that's been largely driven by like your short rates declining on the front end and the 1-year maturity range. We've seen treasuries down about 20 basis points, the 2-year down about another 50 basis points, and then the 5-year down about 60 basis points as well. So when we've had maturities, new funds coming into the fund, we've been reinvesting into lower yields, which as a result, you've seen a gradual decline there. So as I mentioned, the current rate, or actually the June 30 rate, was 4.54, and that is down from a 4.78 12 months ago. Moving over to the pie chart on the right, you can see our STIF allocation. You'll notice that assets are allocated across highly liquid securities, which kind of fits the fund preservation of capital and liquidity. The repo portion of the portfolio, that's our overnight cash vehicle, and we're managing that to meet immediate liquidity needs. That investment is collateralized with treasuries and agencies, same risk profile as the portfolio, and it is delivery versus pay. So the treasury portion of the portfolio, there are two parts there. The main part is the front end ladder. So we're laddering treasuries out 12 months. Currently, we have 1.75 billion maturing each month to provide an additional layer of liquidity to participants. And on top of that, we have layered in out to about 4 months T-bills as well. And as you guys may know, the way the curve is inverted, T-bills are yielding a little bit over 4%. So that's one of the reasons there. The agency portion of the portfolio, that's predominantly callable securities, where we're able to invest excess cash out the curve and pick up a little bit of yield. Very limited credit exposure in the portfolio. The trade-off is basically interest rate risk.
Probably work before you hop to the other one.
Yep.
Before, with highlighting, we're talking about it really in the context of the pension plan side here too, but it's also the cash vehicle for various entities within the state as well too. So, managing, the pension is just one of the participants in the cash management pool, piece, and Brett touched on the types of securities that are in there, and it's definitely a plain vanilla approach, but we felt over time like that was the right level of risk for participants and cash, not only for the plan, but for also other participants. So from the time to time, we've certainly been pitched other vehicles that are yield enhancement, and we've really stayed out of that for the most part. The benefit of that over time has been we've seen other, in the case of some state plans, have issues with breaking the buck, restricted products, or during the crisis, reserve primary fund. Over the time, we've kind of stayed away from all that, and that's kind of been the trade-off. Is okay, there's other places to take risks, but this is probably not the place.
So on the chart at the bottom, just draw your attention to some additional characteristics of the portfolio. So you can review those at your leisure. Next slide. So on this chart, we're looking at the STIF rate history. It's worth noting that the assets are right around 50 billion here. So I'll draw your attention to the red line, which is the STIF rate, and the kind of yellow mustard color is the iMoneyNet composite benchmark. Also included for your reference, comparable treasuries and also the Mellon STIF. As you notice to the right, as I mentioned in the previous slide, all short rates have declined. Currently, the STIF is at 454, iMoney is 424. The 6-month bill is around 4.25. All these are as of 6/30. Rates have actually come down a little bit lower, as well as the Mellon STIF, which is right around 430 as well. So as you'll notice, the red line exceeds the other lines for the majority of the time periods here. The portfolio will outperform comparable rates in most periods due to the positively shaped yield curve, as well as our ability to invest out the curve and pick up yield. So it underperforms when rates rise rapidly. So you'll notice kind of on the right side of the screen around the 2022 range when the Fed started tightening and rates started rising very rapidly. We just couldn't keep up in terms of reinvesting in higher yields.
You see the tail end of that occurring there at the very left-hand side of the chart too. The challenge more this time is that we've really maintained that inversion on the front end. So we've really been restricted on the ability to go out and do the typical trade we've done over the years on that extension to grab a little more on it. So we'd like to see that resume a little bit, that normal shape on the front end.
The volatility of assets in STIF is extraordinarily low.
Yes. All very sticky, and that's one reason why the approach has always been to give us that flexibility going out to 5 years on that. And the way we've added and why that number is really north of the other money market over long periods is we can take that little extra part of the curve, take it without the credit risk side, and grab a little bit on there, kind of write callables on it. So over long periods, it really works well. As Brett said, the times it doesn't is a really rapid increase where we've got money on the books we can't deploy it really quick enough, but the trade-off works well long-term. Moving on to slide 5, looking at the core investment grade fixed income as a whole, kind of start with a pie chart on the left. And what used to be 100% of this book was in core. And then we went to a 90-10 split. And really the origin of that was back to the financial crisis and the thesis that everything that was being done then, policy-wise, was really going to change it, where a lot of your brokers and banks out there were not going to have the balance sheet they had in the past to take credit down and carry it on the books. So we felt like at some point when there was a flight to exit and there was stress, there would be limited buyers, and we really want to be sitting on some liquidity then at the point in time too. So we sat on that for a while, waiting for that, really to occur. And then eventually when we got that, as the financial crisis, we put money to work. And then again, we had it most recently with COVID, where we're sitting there with dry powder. We had credit spreads blow out for a little bit. And I was amazed. Number one, we were remote and the busiest we've probably ever been out there. We were out there just showing bids on quality names of paper. And I was amazed in the electronic systems, we can see if there's a cover on it or not when it clears. I was amazed how often there was no cover. We're the only bidder. And we were out there bidding at levels. And I'm like, that we're really aggressive. I'm like, hit it if you want. And I was shocked. I mean, we were one of the ones that stuck with. We bought some 2-year Goldman paper at like double-digit yields at one point on it. Unfortunately, that party got ruined by the Fed too quickly in my book, but for us at least. But it was really just kind of using that dry powder to take that opportunity, whereas other funds that didn't have it because they didn't have liquidity in their pool as a whole couldn't do that. So that's the origin of that piece. But the green sleeve also evolved. This short IG piece that's 2.7% there really came out of stiff there being at zero rates. We're near zero at the time with options we had. And we took a look at some really high quality IG on the short end, bought some of that as kind of a proxy or substitute for stiff, and then have kind of let that run off at the time to add a little more yield to the book with really minimal increase in risk. And that's really panned out. We looked at it from the last trailing year. That short IG did about 5.8%, and the stiff was doing 470. So had 100 basis points. Now, frankly, what's left in that book that hasn't run off is about the same yield as our stiff book. So it's kind of just in runoff mode at the end and maturing off on us. And the duration's about the same as our stiff as well too. So continue to see that kind of disappear. We'll really focus on most of the discussion post this on the core part, really that big blue box there. And if you look down there on the bottom left, a return summary on that, the investment grade fixed income encompassing everything as a whole, including the other two pieces, has continued to outperform over most time periods. The 4 basis point underperformance over the last year really reflects curve positioning and cash exposure, where we were a little hesitant to go out there and take on more duration at where things were. So just a little bit under for that time period. And then the top right, the relative weighting within core, you can see we've been slightly overweight corporates. That's been coming down and is trending down even farther from this number here. And that's a reflection of valuations, which we'll get to in some other charts here.
Jeff, quick question. Is it, given your comment, Brad, about stiff assets being so steady, and it's probably restricted by statute, but I'm still going to ask it, like, are we too conservative potentially in stiff?
So it's worth mentioning, I think, that, by policy, we can invest out to 5 years. At one point, I think it was 7, and we ratcheted that in after recommendation from a consultant. So right now, when it makes sense to pick up yield, we are exploring callables, callable securities, so basically selling optionality, getting paid a decent amount, a pick over treasuries. So for instance, like a 5 non-call 3-mo with a quarterly call, you might pick up 70 to 80 basis points over a treasury. So when it makes sense, that's what we're doing. We're also exploring longer locks. Kind of the rate cuts haven't come, in anticipation. So we had some 9-month locks that have kind of rolled off as well. But with that said, the duration on that portfolio is 0.6, but the average maturity is 2.1. So a lot of those securities are in fact callable. So we've kind of locked in those rates and achieved a higher yield than we would have probably in repo as a cash vehicle and on the short end of the curve as well. So
I think it's a very fair question, and Brett really characterized it pretty well there. If we were running it true money market, everything was inside short, I would tend to agree on that too. Where we're doing that is taking the interest rate risk on that part of the curve. I feel like that's more appropriate than the credit risk. And I think when things are calm, it's a natural thing to go out there and say, maybe we can do a little more on this and there. But the benefit of the time we had at the desk is that I remember how stressful it was for some plans when there was an issue with that being a cash piece of other participants that are in there. And there's a conversation about basically breaking the buck on it. You're not going to get back less than what you put in on it. So that's really kind of always been the underpinnings of kind of what we do at the end. And the trade-off has been, we'll take some interest rate risk because it's sticky and we know it doesn't have to all be liquid and everything's done on a cash return basis on it. And that's just been the trade. But especially as we've seen the thing grow, I mean, it was.
when I first started,
Yeah.
we were right around 8 billion. Obviously,
Now it's
I've been here
50.
quite a while now, like my entire 20s, 30s, and 40s. So kind of crazy to think, right? But it's grown over time. Right now, we've hit 50 billion. I believe the high water mark might have been 52, kind of after COVID. Some of the federal funds were deposited and have gradually kind of gone out. I know it had 49.8 as of 6:30, but we're like a little over 50 billion as of July 31st. Another point to make as well, Jeff brought up the money market fund. So if you look at the iMoneyNet, which is a composite of the largest money market funds, it's a 424 right now. We're a 442 as of July 31st. So we are earning a premium to that with, extremely liquid and low volatility assets as well. So
It's probably the liquidity point. That's the question.
liquidity and preservation of capital, that's kind of the main.
That's the lever
focus.
we could talk about.
Yeah, those are always, we say, the
Credit risk.
primary goals, right?
Yes, because of the nature of the funds, right? You got the general funds in there, you have, hospitals, other municipalities and things like that, as well as pension assets. So
To be fair, so there are things that we could do and could have done always over time that we have not done. Which is kind of where the problem came for other states, whether it was a structured vehicle that had AAA wrapper on it, or any like that, or there was other programs that were out there trying to do that, too, over time. So there were more AAA rated bond names at one point because we can do AAAs, but there's really not many left, and we couldn't really get enough to even impact a 50 billion book anyway. At the end of the day, and then we've, CP is obviously a natural question that people ask on it. Is the one area we've thought about a lot, and then as it's grown again to how much impact can we make with it, and which risk would we rather trade off on, right, at the end of the day on this. But good question. Moving on to slide 6. Again, focusing on the core book, you can see the breakdown of what's in there between the mortgage, treasury agencies, and corporates. On the corporate allocation top right, you can see a sliver there of high yield within corporates, and really that's a function of the fact that we don't have forced selling rules. So we do not have to sell anything. We can let the credit research team make the decision on if it's something we should be concerned about getting out of or not. Big fan of having that flexibility. We also can do split rated as long as it has investment grading by at least one agency. Best example of the story around that flexibility that was positive was back when the autos were under stress years back, and we're pretty much all downgraded below investment grade. We had the authority to hold on. Felt like from a credit side that it was all money good and it was really overblown. We held onto the names. Everything worked out fine there. And in fact, we had alerts set up where when it got upgraded back the first time by one agency, I think Brett was buying bonds within about 30 minutes.
15.
So
we were
to pick up on that. So it's that part is kind of flexes over time, but that's really more legacy pieces. Down on the characteristics, obviously notable is the duration part. You can see we're a 0.4 short there. We've been narrowing that gap on that too, but have really been, I think, a good question, and I'll show in a later chart that came up here recently was about like, well, it feels like we've been that for a while, and we have been. In the low rate environment we've been in for a number of years, but it's been a while since we've been actually long duration. We've changed up and down where we were relative to that, and I'll show you that here in a second. Slide 7, just capturing the recent history from 6/30/24, really last year plus. A lot of noise, and you think about all the noise we've had since the end of the year. But really, we've been pretty range bound, and we're really not that far off where we were rates wise when we started the year, calendar year, ironically, although it feels like dog years. So moving on to slide 8. Looking at the shape of the curve, the gold number there is where it was 6/30/24, the green at 6/30/25. We've seen that steepening of the curve as we get to the intermediate part and longer part. And if I drew a line on here and where we were this morning, underneath there, kind of red, the red line would be a little lower on the front end, down about 11 basis points from that green line, with a pivot point around the 7-year, and then rates a little higher than that green line, by about 10 to 15, as we've seen a little more steepening there with what's going on in the markets. On to slide 9, we'll talk a little bit about the kind of some of the strategies we've employed over time in managing the portfolio. Really, the portfolio is actively managed around market conditions and valuations, really focusing on a few different things. Monitoring and positioning the portfolio from a duration standpoint, a sector standpoint, down to specific issuer or company level. On that, the credit research team really works to establish the overweights or under recommendations at the issuer level. And it's a pretty big universe for them. As you can see, the index data in our investment universe is 1,100 individual issuers, 6,600 CUSIPs, and with a $12 billion book, we own quite a bit of that. We own roughly half of the issuers and roughly half those CUSIP numbers. So they're making conscious decisions on that. And the way to give you a little feel on how things work day to day would be around new issue market. We're doing secondary trading as well, but a new issue market daily, we're going to have a flow of issues to come in. That's going to come through the trading desk. The details on XYZ companies issuing 5 and 10s or 20, whatever the could be in them. So that goes over to our credit research team, split up by industry group to Mike and Carlene, and they're going to come back with that with some comments around issues with the company, where things are relative to their peers, where our weightings are relative to that name, where valuations are on it, and they're going to come back with that to the desk, and we're going to use that to formulate if we're going to be in that issue or not, either passing, involved, and subject to pricing levels, a variety of things. But that's kind of the normal workflow through the research team. So on the left hand in the charts, talking about some of the different methodologies we'd use, a couple of examples, and this data really cuts off data to 2019. That was kind of where the fact set data limitation was on it. So, but a couple of examples of kind of how we take things up or down on it. The top chart is our exposure to corporates relative to the index. And you can see in 2020, we had taken that up higher. And when we flip forward a couple pages forward on page 11, you'll see that was when spreads blew out. We're going to take our exposure up to corporates to take advantage of that value. Again, that happens again in 2022. And then yet we'll take it down when we don't see the value there. Like right now, if I put the levels, again, we'd be pushing south of 1% on that number. A similar approach to things in the duration. While we haven't been long duration during this time period on it, you can see what we've done relative to the benchmark. Looking in kind of 2020 timeframe, you start to see us really push to become shorter duration. That's the reflection when we go to the next page on seeing where rates went. And then again, in 2022, you start to see us take it back up as really rates were starting to rise again, and we were okay taking on more duration on it. And really that period in 2022, and you'll see what it did in returns, that was the largest duration we've had in 30 years here. Our typical policy range is going to go up or down 1, and what was going on and rates near 0, we just brought up, listen, we think this is the time to take this even shorter. And that ended up playing out for us. When you look on slide 10, kind of representing those periods I was mentioning, there at the bottom in 2020, we kind of the floor is when we were pushing duration to be really short. And then as rates resume there in 2023-4 is when you see us kind of narrow that duration, back up.
Not entirely. You're not flat duration.
No, we're still like 0.4. And we'll get to some reasons why I'm a little perplexed on the crystal ball is pretty hazy on the long end because of some things going on, but it really reflects that. It'd be a while. We'd have to go back a pretty good while if I could even pull the data on it when we were really long duration, when rates were much, much higher. Yeah.
So next slide. So what we're looking at here is basically spread history for the credit markets. The green line, high yield, red line would be IG corporates, and then US agencies at the bottom. You see a lot of fluctuation there in the agency portion, kind of dwarfed by the scale. So talking about the high yield markets, I mean, really, IG and the high yield has been a pretty wild ride year to date, right? So we started out in high yield around 290, spreads blew out to 390s range on kind of the uncertainty surrounding tariffs and you know, kind of the outlook, you know, whether we're going to have inflation, growth, whether or not growth was going to be impacted. And as that has kind of settled down, moving more towards you know, kind of the June 30 time frame, you know, we basically retraced all that by about 100 basis points. And kind of the same thing here in IG corporates as well. You know, we started out around 80 basis points or so the year, and then blew out to about 109, 110, and kind of retraced back down to 86. And it is worth mentioning that you know, IG in the IG space, spreads have continued to tighten. We've given up a little bit here in the last couple of days, but at one point we reached levels, basically 27-year lows in corporate spreads. So spreads are very tight.
We'll see that again here in another chart coming up too. Moving forward to slide 12. So so what does all that mean on the strategies we take, number one, and the how we manage fixed income as a whole? So these two charts kind of capture, again, focusing on the core fixed income, since that's where we have the long history. We went to a total return mark to market daily in June of 97, that time frame. But you can see kind of coming, obviously, in those early 90 period, coming from a much higher rate environment, really positive for an absolute return numbers that are in the top half there. And then flipping all the way to the right, you know, you see 2022, and we saw that massive spike, 200 to 300 basis points across the curve, and what that meant absolute. But the different strategies we employ that we talked about, what does that mean relative wise performance? So really you get a look at that down at the bottom on kind of how that's played out over time, which as a whole across there, something that we're proud of. That really the outliers, like 2009, we had a pretty big excess return. That was really a combination of, you know, in the middle and coming out of the financial crisis, really great credit calls from the team doing the work. So we avoided a lot of problems then. And we also pushed more money into corporates there, where we had corporate spreads collapse in 300 basis points during the time frame. 2014 on the opposite side really was a time when the consensus coming in was rates were going to head higher, and the exact opposite happened during the year, and pretty much nobody was long, and it was more challenging then. And then the very short duration time period in 2022 we mentioned, but those are kind of the outliers. Really, the mentality and the way we do it is really a grind it out, you know, yearly, and we're trying to add value through the credit work we're doing over time, trying to get some, you know, calls right directionally where we're headed, and then when opportunities arise, have the conviction to take advantage of that, you know, when it happens, and that over time has certainly, you know, worked out for us.
Next chart. So on the chart on the top, you'll see sector spread versus average index sector rating. And I probably need to explain the line here. The line represents the rating for the index at each, and the spread level at each rating level. So as you'll notice, that's a positively shaped curve, as you would expect. As you move down in credit rating, you increase risk as well. So of note, since we presented this back in September, you know, kind of everything has, the curve has shifted lower, and the dispersion to the line, which would be the average rating there, has also, you know, there's just less dispersion. You know, I think that's a function of, you know, kind of where we are with credit spreads as well. Any questions about that? Okay. Below, you'll see basically that bar chart here where we monitor sector weights relative to the index. The long-term portfolio is in blue, and the index is in red. You know, our relative exposure by industry is fairly neutral. And there's really no overweight or underweight that's greater than 1%. In fact, there's really no overweight or underweight that's greater than 0.5% here. So no notable changes from the last time we presented it.
Yeah, it's a reflection really of the fact that there's, and you'll see it on the next chart, there's really no standout value to me. I mean, we've had times we would expand these. So coming out of the crisis when bank spreads were really wide, we went overweight banking. If there's anything kind of to be expressed in the near term, is I could see us kind of pushing more like utility a little higher, more defensive with spreads at really tight levels.
Next chart. This is a kind of a new chart to the slide deck here. Basically, for each sector, you can see a high and a low watermark there in terms of spread levels for the past 10 years. The red dot, that's where we are as of June 30. And as I mentioned, spreads have tightened in some from that level as well. So, I mean, as you can see, or with little exception, I should say, spreads remain at kind of the low end of the range. So this really drives home, I think, where we are in terms of corporate spreads.
Ironically, I think I mentioned this last time on it. So it's a pretty ugly chart from a relative value standpoint. I wouldn't say I have any widespread credit concerns though right now with where companies are, but there's definitely no screaming, not even a whispering, value out there right now in the market as a whole. Let's move to 15 and the fun topic. Obviously Fed independence, what's going on with Fed Governor Cook. And I was looking at these slides yesterday and this one and the next slide of FOMC stuff. And given the changing makeup and the leadership at the Fed and the uncertainty, I'm not sure these two slides have ever meant less. And I say that, kind of jokingly a little bit because these are June 2025. Now, as we get another dot plot update and data in September, the makeup's changing quickly. This is 3 months old. What is it really telling us on what the big issues are, uncertainty on it? And probably not a lot at the end of the day. I mean, this data was showing a trend, a little trend up in the previous data for PC inflation, for core inflation, percent of tendencies, kind of no surprise there. The dot plot numbers have moved up slightly north, but I mean, what are we going to see in the thing? More dispersion on the dot plots going forward? I don't think all we can expect is a little bit more chaos. So as far as the FOMC and rates are, the meeting's coming up on the 17th. As of yesterday, it was 89% was the futures number for 25 basis points. It wasn't too long ago we were talking about maybe even a 50. Futures aren't showing that possibility anymore. And the 10/29 next meeting after that is like 40% of a second cut on it. But I don't have any great insight. It's funny when you think about visibility. I said it's all relative, right? Your visibility in fog is 2 feet, then 10 feet maybe feels a little better. But we'll see what occurs there. But it certainly hasn't been boring. Let's put it that way.
Payroll spreading.
We're going to get
Payrolls will not be this Friday.
Yeah.
It'll be the first
we're going to
Friday
get
of
core
September.
PCEs tomorrow.
Right.
Yep.
Yeah, core PCE at least tomorrow. Yeah.
Yep. Week.
So we'll see. I think there's obviously on the topic. Independence is obviously the big question. What happens there? Is there a replacement in the near term coming up on it? I'm not sure how it's going to play out. But if anybody has any sage advice there, we're all ears. We'll hop on to 17. So looking at the top chart here really is the bond yield. This is from the bond yield forecast function in Bloomberg, which really is just kind of a proxy of where all the different firms are and what their expectations are in the near term. Little challenge with this number. This number is updated monthly. So everything in the table with the Q numbers, Q3 25 and right, that was done late July. But the market yield on the left-hand column is the day I pulled this. So that can be a little deceptive if you're looking at that as like what their expectations are. Having said that, I don't think the 30 and 10 were that far off when they did this. But consensus there really is for some modest declines really across the curve. The spread kind of continuing to choose 10's example here is continuing to widen a little bit. And really the 230 curve now is at 123, We're really at the recent wide, I think 3-year wides on that as a whole. There will be an update on this later this week. But I think it's really, my take really is there's a pretty good conviction that the short end is going to continue to trend down. I think clearly the bias that's going to be pushed towards the FOMC is going to continue to push rates lower. The wild card is the long end. Is how that's done going to cause more discomfort and uncertainty? And on the long end, is there any policies that are going to push the long end? So that's really where, at least for me, there's a real lack of conviction on what happens on that end. I think we're kind of going to be range bound in the near term. Tips wise, the 5-year tips break even rates down there. The market's really telling you that it doesn't really see the inflation risk as materially changing. I honestly thought there might be a little more reaction into this recently, but it hasn't happened. Moving on to slide 18. I really put this in there because it's in the context of doing asset liability work and getting inputs. This is one of my favorite data points. So just to make sure serial or match. So I'll use the left-hand example, the 1985 there. So the blue number there on the line point is where yield to maturities were, and the orange is what you returned for the next 10 years from that date. And it really gets to the point is like where yields are is what the basis of your expectation should be to earn in the next 10 years. And so that's the easiest input when you're doing that modeling at the end of the day on it. So you can see, and if you're curious, the 12/31/15 number was 2.5, and that date to right now is number is 1.8, so right in line. So we're going to be. So again, I think that's the forming expectation. So what does that mean for where we are, now? Well, this is the H167 is our broad benchmark there, and really we've been in that 5% range where we are. So, which in perspective has been, is a great place to be relative to, back for 15 plus years at the end of the day on it. I think the challenge when we talked about relating it to the asset liability and the plan structure as a whole is if we go back into that 90s and earlier period when we were longer duration and really fixing in general as a higher return, you had your low risk asset and really your downside protection providing yield and income as well too. And we went for a decade of it really wasn't much you were getting in the meantime. So you had this kind of insurance policy that was providing almost no return, trying to hit this actuarial number on it. At least the good news is that part has changed some, and at least that's not as big of a burden on it. I would always say back 5-10 years ago, the worst thing that could happen to the plans is the rates to stay where they were because your expected return is not changing over the long term. So I think there's good news plan level and what that means for us and other plans long term. Flipping to 19, this is just a parallel shift and certainly not calling for parallel movement, but just to give some framework around what the absolute return numbers are and different changes and rates there. And the biggest change from, again, back to 5-6 years ago was that orange bar of income return is a lot bigger than it used to be and gives you a little more buffer around some movement in what you're going to make in the asset class versus, having slight increases and having negative returns. Now you've got a little buffer up to 75 when you're at least still, above water on a 1-year basis at least. Again, our expectations are for rates to decline modestly in the front end, long end, uncertain, at least from our side. No real concerns on inflation that you see in the tips market. So I would kind of characterize, 4 to 6% range over the next 5 years for our investment grade fixed income. And then lastly, and then I'll take any questions everybody has on it, kind of current environment and positioning. If I could redo this chart, I'd probably put a question mark behind the first bullet. I'd make the second bullet really bold, and I'd put an exclamation mark on the third one. Because I think that fiscal policies remain uncertain. With the tariff uncertainty starting to fade to some degree, that's not a bold statement. I mean, there's still some uncertainties in how these things play out in the market and a little bit on and off with the deals. And so I think we're starting to get some clarity, but again, that clarity is, on a relative basis. The future monetary policy being on the dovish side, I think it's pretty confident on that call, but the Fed independence concern, and then the IG spreads we touched again, there's not much there value-wise or not. Our near-term positioning really is going to focus on remaining pretty close neutral on sector weighting and duration. until we really get some better material look on where there's some real value and where we're headed. And our corporate exposure really going to maintain a quality bias. We have let a lot of that book, again, as a reminder, the way we run it longer duration really looks like you took the ag and cut the first 5 years off. So historically, we're going to roll out bonds as they get shorter. We've done less of that, and we have a little more of the book that's inside of 5 years, which has helped us out as the curve is reshaped, steepened up. And continue to take advantage of that steepening as we can, and then kind of look to have more quality in the corporate book with spreads down where they are. And that's really a look at it. Be glad to take any questions anybody has.
None? Jeff, thank you, Brett.
Now we'll go from one Smith to another.
All right. All right, we're bringing lunch.
Yeah, we're bringing it in at the right time, I hope.
All right. I was going to say that at least I'm not standing in the way of lunch. That would be Chris, but I see you're being served lunch, so I'll make this brief. All right, if we can go to the next slide, Matt. Thanks. This is the public equity team. I want to kind of give you a little bit of background on everybody. When I came in, Michael and I were talking, and Ben affectionately referred to me as a lifer. And there are a few of us still remaining, but I do want to point out that we do have a growing level of experience coming on the team, and the focus or the goal is to kind of build out that continuity. We had, kind of grew in size 2, administrations ago, and then it kind of shrunk. We were looking at Callan as an extension of staff for a consultant, but still largely doing all of the work ourselves. But it was just trying to preserve, that continuity throughout the knowledge base on the team and making sure that we allow time for building out of the team for future generations. So I've been here as of this week, 24 years, and I have been in the equity team the whole time, and I am pleased that we have 2 very skilled, very highly qualified individuals on our team now that I will have them introduce themselves and give a brief background before we get started.
Greg Taylor, been with IMD for 9 years. Previously worked as an economist for a couple of years in London, coming over here for business school.
And I'm Hunter Brackett. I joined the team in May of this year, so still fairly new. I was previously at Cap Trust here in Raleigh for 13 years, where I oversaw equity manager research. And I've also spent time in both sell side and buy side equity research roles covering the financial sector.
And then you'll notice on the slide, we do have a vacancy for an investment analyst position that we will actually begin interviewing for next week. We've had some kind of fits and starts with this role because of the dual responsibility of managing both internal assets and overseeing external manager oversight. Rarely do you see individuals that possess both. So we've decided to kind of pivot in our evaluation of candidates and focus on the technical and transferable skills. We can teach the qualitative, but we'd rather have more of the quant to build out our trade capabilities internally going forward and to provide a depth of analysis on the manager monitoring and reporting. So more to come on that. Next slide. The role of the public equity portfolio. This summary came right out of our investment policy statement. So RVK kind of touched upon a little bit of it. Kevin and Chris may touch on it throughout their presentations, but the primary role of this asset class is to identify long-term, low-cost, alpha generating strategies, and then locate opportunistic strategies that we can add at the margin to add incremental alpha. In addition to kind of just diversifying our opportunity set across geography, market cap, style, and serve as a liquidity source for the plan at the same time. One area of focus I want to point out, the opportunistic allocations. This is one area we're targeting this year, and just trying to drill in a little bit more to see where we can find additional opportunity sets, given, we have a relatively low risk portfolio now, and we have that opportunity to add that risk and seek out additional alpha. So these are the objectives that are possible through both that internal and external management. We utilize the passive primarily in the efficient market spaces, domestic large cap, and active management in those inefficient marketplaces that require a greater degree of focus on stock selection. Next slide. Okay, portfolio allocations. In the top left box, if you'll look, we have had a meaningful increase over the last year, and that's primarily due to market activity, but it's also positive stock selection and allocation through our manager selection. So we're happy with that outcome, but we're cognizant that that's not going to always be the case. So we are just kind of mindful of that and just continuing to look for ways to kind of preserve the capital at a lower, level of risk, but seeking the alpha where we find that it makes sense. The number of mandates in the top right, it dropped just marginally. And that was from a reduction of an active manager that no longer really fit our asset allocation model. We were utilizing the strategy as we have before, given the staff is so small, to kind of build out internal knowledges and capabilities. So this was a strategy that offered us an ability to do some factor driven types of approach, and we were able to kind of model that internally. Greg was able to kind of build a factor strategy that replicated what we were accomplishing with the external manager for a fee. So we were able to kind of wind that down, give the plan some cost savings, and move forward internally. Asset allocation on the lower left, we are overweight domestic currently, and I don't want to get into that a lot right here. Greg will go into a little bit more detail on our portfolio structure momentarily. And then in the lower right, we have an overweight passive, which is, still resulting from, having that relatively low risk portfolio, serving as a liquidity source for the plan. And, Greg will go into this in a little bit more detail as well. Are there any questions? Okay, next slide.
So this just takes a look at portfolio structure and risk. The top chart looking at current active risk versus a year ago. I think the standout point here is you see the reduction in country risk. And that's a product of earlier this year. We made the decision to remove our underweight to US, which we had not really due to an outlook of the team, but kind of evolved over the past year. So we decided to kind of eliminate that source of risk. And that's really the big change, and has driven total factor risk down, and also total active risk from 91 to 68 basis points. Kind of as Rhonda mentioned, we view that 68 basis points as pretty low. So one of the objectives of the team at the moment is trying to find ways to increase that risk exposure. And then the bottom chart, just looking at active factor exposures. It's kind of, as I mentioned, you see country level, not really many active bets, not really contributing much to risk. Then on the style side, you see we have overweights to profitability, so kind of quality factors and growth, and then underweight value and low quality. But it's kind of given correlations and volatilities of those factors. They're also not a huge driver of risk. But yeah, that's kind of where the portfolio is at the moment.
Next slide.
All right, on slide 6, you'll see the portfolio has outperformed its benchmark almost over all time periods, except for the last 5 years. In U.S. equity, the concentrated market over the last 5 years has been a headwind for our active managers. As we talked about, we are mostly passive on the large cap side, but we do have some active managers in mid and small caps. On the non-U.S. Equity side, the underperformance over the last 5 years was driven mostly by our growth managers, as growth has underperformed value, which is sort of the opposite dynamic of what you've seen in the U.S. markets. I would point out some improved performance over the past year, both for U.S. and non-U.S. equity, as this market rally has started to broaden out beyond the mega cap tech stocks. We've seen improved performance from a number of our active managers as a result. And the last thing I'll point out on this slide is just the strong absolute performance of our non-U.S. portfolio. Over the last year, it's up 18%. And you can see that's outperforming the U.S. The weaker dollar over the last year, among other factors, has been a tailwind. And that's kind of a notable shift from what we've seen in prior periods, where we're seeing that non-U.S. exposure really helping us. Next slide, please. So just looking at attribution over the last year, the biggest driver of our outperformance was our U.S. manager performance. So we saw improved results from our all-cap growth manager, again, due to that more broadening market, as well as an activist manager that we have in the portfolio. Our international manager performance was relatively neutral during this time. Our large cap managers performed well. That was offset by some underperformance by our international small cap manager. And then on the allocation side, you can see U.S. allocation was a slight negative. As Greg mentioned, we had been underweight U.S. equity prior to some rebalancing earlier this year, so that was a slight headwind there.
Next slide. Okay, on this slide, we're reflecting the ongoing activity within this portfolio. This is not an annual exercise for us only. We're constantly seeking ways to lower cost, provide plan liquidity, and identify ways to build long-term relationships with our external asset manager partners who are focused on meeting, customized needs for us through separate accounts where we have a preference because we are maintaining control of those assets. We conduct regular reviews of the portfolio to see where we are adding value and where we're making intended bets versus, unintended bets or misfit risk. And we seek to utilize our size to get the best possible contractual terms and fee arrangements possible for the DB plan, as well as where there's opportunity with like managers trying to forge favorable terms for our DC plan as well. And we found in the last CEM benchmarking study, we've had some success in doing so.
Question for you, not necessarily this slide, but when you think about allocation, like passive active, you're 60, or about 60-40. If you were to parse that into like large cap versus international or small, like how does that change? Do you think about it from that perspective?
We actually do. We have reduced or cut our active manager lineup in half over, say the last 10 years or less. And we are targeting those areas like small cap, where we feel like it's very inefficient. Looking at, activist strategies within both US and non-US where we feel like they can add value that we may not necessarily be able to do internally. Areas like global and mid-cap are areas that we're still kind of focusing on where can we identify good opportunity sets, and those may be areas that as we build our internal capabilities, we may do that, beginning passively maybe, and then as we build up talent and skill and tools, be able to go active internally in those spaces. So just trying to identify where we can do it better, efficiently, internally, and then trying to identify where there is skill in stock selection. And given the size of our staff, I mean, doing, the level of fundamental research and at the level of granularity takes a lot of team, a lot of resources. And so we're cognizant of where we do have the strengths and where we're building those strengths, but, outsourcing to those asset managers, those areas we feel like there are greater opportunities for return in active management.
And just to build on that, Rhonda, so you cut your use of external managers in half. So what does that look like today? How many external managers?
If we go back, Matt, to what slide? Yep, that slide 4.
Oh, there we go.
Yep, we are currently, what is that, about 8 and 8? Yeah, so it's been significant if you look over time, and I dare to say even going back past 15, it was even larger than that.
Most of those 8 and 8, are they more, just to follow up on Dan's comment, more focused on sort of small mid?
We had a lot of large cap historically that was actively managed. And we just found that for the amount that we were paying out in fees, we just were not getting the return. So quite a few of those managers left the portfolio in the domestic space, and I dare say in the non-US space as well. And then we took a decision under the prior administration with Global to not have dedicated exposure, but rather use the levers of non-US and US to kind of build up that ACWI, ex-US IMI exposure, or ACWI exposure. And what I've found is when we're looking at opportunities to rebalance our portfolio, it becomes very challenging when you've got these bifurcated and you're trying to figure out how much you got to pull from US, how much you got to pull from non-US to kind of satisfy that requirement. So I think that we're going to spend some time looking at, how we can solve for that problem, implementing those dedicated global strategies, again, whether it's internal or external, and how we can do it so efficiently.
I think the other area I would note, you can see it historically, we used long biased hedge funds in the portfolio. And that's another area that we're doing a lot of work on to see if it makes sense to add it into the portfolio. So I think we used to have up to space. Some of those we had on our managed account platform, so better fees, better economics, and transparency. But those have kind of gone by the wayside as well. So we're looking at a few managers there.
Yeah. So when I mentioned we're relatively low risk now, we want to increase that active risk where it makes sense, and you'll start to see that number tick up in the number of managers that we have in our portfolio going forward. Okay, if we can go back, Matt, to slide 9. Okay.
Yes, I'll point out on here, our domestic equity portfolio is in the top quartile of the peer group over almost all time periods. Again, excluding the last 5 years, some of the challenges that I highlighted earlier. I do think that our significant exposure to passive strategies has probably helped our peer relative performance, just given it's been a more challenging environment for active managers. And that'll be something, as we talked about, that we'll assess going forward, whether that makes sense. But I think it's certainly helped us relative to the peer group over most of these time periods. And then just on slide 10.
Oh, wait, slide 9 is great.
Yes.
Thank you.
Comment on that.
Let's not leave that point. The two hardest places in the entirety of capital markets to make alpha are domestic equity and investment grade fixed income. And we've just heard from both you guys that we do it reliably. And so, thank you.
We're always hesitant to take on those kudos because we know we can turn so quickly.
Touche.
Yeah.
All right, and then looking at the international equity peer comparison, so not quite as favorable. So it has been a more challenging environment for us relative to our peers, and particularly over the last 5 years, again, due when we're evaluating managers, and that has started to pay off, and we're starting to see that improvement. So good to see that.
Is the benchmark on this page the Equity XUS? I actually would think you've done a very good job, even though I know you've underperformed. The variance in the last 5 years between growth and value internet, it never gets talked about, but it's pretty incredible.
Yeah.
So, yeah.
Well, thank you. All right, on the next slide, Greg's going to talk about our internal management. Now, this is where I will give kudos because, you know, it was a lot, and this was under the time that Kevin was first here that, you know, we started this internal effort, and, you know, we built upon that over time. And, you know, Greg is the trader for the portfolio. Hunter and I help out, but you know, he is carrying the weight of that, and he's done a phenomenal job. So thank you for that, and you can talk about it.
Yeah, so a little background, we first launched internal US passive in 2017. Kind of since then, there's been some turnover in the accounts we managed. Started with a Russell 200. Now it's just a Russell 1000 passive. And then we also have a US factor strategy, which we launched 3 years ago. And then the assets have meaningfully grown over that time. And I think back to the question, I think about 75% of the US portfolio is passive, and on the non-US side is about 35%. So this year we've kind of used those internal accounts to manage some of the flows. So you see those first few between February and April were used to manage both increasing equities at the plan level, as well as that reweight from non-US into US. So some of that money was going into the Russell 1000, the core factor strategy, and then we also implemented a US small cap just through purchasing an ETF. And I think the goal with that is to kind of get interim exposure as we assess the active manager space and see if we can identify a small cap manager to kind of replace that passive exposure. And then maybe touched on earlier, but kind of with the strong performance of markets, some of that money has since come out of equities. So in June, we took some out of the Russell 1000. And then again, last week, we also did a liquidation from that same account.
You want to tell them how the performance was on that trade last week?
Yeah, so I was able to get the trade done kind of in quick time. So all able to trade it in a day and just incrementally beat the close through trading that. Then next slide. Yeah, just the performance of those two accounts. So the Russell 1000, just, the mandate of this is to match the benchmark. Kind of since inception, been able to slightly outperform, which has been good to see. But kind of the expectation is that would never be more than a handful of basis points outside of the index. And then the factor strategy, which It's outperforming since inception, but given the tilts that portfolio takes, so kind of underweight size and growth has underperformed over the trailing 1 and 3 years, but has outperformed year to date. So far it's been beneficial. The money's going into that account in the US.
Yeah, as a reminder, as part of that 0.8 billion rebalance we did in February, this was a target internal US core because it was viewed as a way to diversify some of the stretch valuations in the market around growth names. And so yeah, thankfully it has actually outperformed the broad opportunity set for us.
Okay, and on this last slide, these are our areas of focus going forward. You know, in going into the new governance structure, you know, some of the things that we'd like to see primarily are staffing, tools, resources, because we are kind of growing. And we want to have that reflected in our capabilities to do things. I think, Treasurer, you had a rollout of AI opportunities. We want to look into that. Kevin recently and Chris had a hire of an individual on the team that is immersed in data science. So, you know, we want to find ways that we can kind of implement that in the way we evaluate our portfolios, evaluate our managers, and look at our internal abilities as well. So these are things that are top of mind that we've been having ongoing conversations with Kevin about. Greg, you want to hit the internal thematic?
Yeah, so that's just kind of, again, just keeping an open mind on ways that we can look to take additional risk where we think the returns justify it. So potentially looking at what we're doing internally and just ways to kind of continue to involve that program, kind of moving out kind of the next step along from the existing factor strategy.
We've touched upon the dedicated global earlier and the desires to want to implement some of that. The next bullet point, the private to public co-investment considerations, we've already made some headway here. And, you know, with the Treasurer and Kevin's support, we're, you know, steady moving ahead with that. We started out with existing relationships and looked where there's, I guess, a bit of blurring of the lines where, you know, you've got the late stage venture, pre-IPO opportunity sets that, you know, long only managers are looking to kind of capture alpha going into and coming out of IPO and then holding these positions over a longer period of time within other parts of their portfolios. And we found this to be accretive to us, and we have identified managers that do it well. So we started out with existing managers. We're working collaboratively with our private equity team in vetting additional opportunity sets through new manager relationships. We recently added one about a month ago, and we're continuing to really find some value there. So that is an area you'll see more of as we kind of go into the new structure as well.
As you continue on that strategy, is the goal to do that mostly through managers, or would you like to eventually be able to source this direct, use them as a stepping stone to do stuff directly?
That is always on the wish list. But here again, staffing size kind of constrains our ability to do that. And I mean, I think the Treasurer and Kevin are very cognizant of that. And as we move into this structure, when we talk about what that staffing model looks like, I do anticipate growth in the team and being able to build that strength and that intellectual capital.
Yeah, I think ties a little bit to the thematic, but I think the higher priority would be to build out the resources to have, you know, thematic portfolios assembled directly in-house, where we could, let's say we look at public energy as maybe being dislocated or underappreciated, in terms of the return and risk opportunities, and we want to deploy some money into that. It'd be much preferable if we had a research team and the ability to exercise. We can trade US names easily, but to do the fundamental research. So to me, that's a priority to build out over the next couple of years and continue to work the managers, existing as well as new relationships, to originate private co-investments. And then at some point, maybe we can get to the point where we start to look at some of these on our own. It's just part of a pre-syndicate build. We do a little bit of that on the private equity side, the pre-syndicate aspect, but even that's relatively new for us.
Yep. And Kevin touched upon the hedge funds, but Hunter, if you want to elaborate on what we're doing in that space currently.
Yeah, I mean, we really don't have any exposure there right now, so we're just kind of taking a broad look at what might make sense. Everything from market neutral strategies to long short equity, active extension strategies, could be a possibility. So really just kind of taking a fresh look and at this point, and keeping an open mind in terms of what direction we might go. So we're still kind of early days on that.
Yeah, because I mean, hedge funds at the plan level hasn't been this dedicated type of asset class. I mean, we're utilizing hedge funds in multi-strat, we're utilizing them in the credit portfolio, we're using them in a number of areas. And so we're just trying to identify what are those opportunity sets that make sense within our long-only structure and how we can add value by implementing those. So it's been an exercise that had some fits and starts. As Kevin mentioned, we started out with them on a managed account platform, had to unwind that under the prior administration due to the size. I mean, we're such a large percentage of plan assets that to really get the value and return out of these, we need to put money with it that's going to move the needle. And we just were not able to put enough money in these strategies to really make a difference in the portfolio at that time. And we hope to change that going forward. And then lastly, activist strategies. We've had some success with utilizing these on the domestic side. Now we're going to look a little bit more closely into where those opportunities are within the non-US space as well. Japan is one area, Kevin and I've talked about, that seems to be very attractive, may be able to afford us some opportunity in that space. But, just looking at activists more broadly and see, are we utilizing them as effectively as we can in the spaces that we should, or is there an area of opportunity that we're overlooking?
I think one of the great things about good performance in fixed income, it's kind of manifesting itself out here in like a lower tracking error, because you're just kind of going to take what the market gives you, so your duration underweight, you kind of get out a little bit.
We had obviously had more when we took that big bet. It was
Yeah.
Good track, it was good.
Yeah.
But typically, if you looked at our methodology on it, it's pretty consistent.
Yeah, but you have this bank of like kind of good performance that like allows you to retrieve when the market's not really offering you much. And in this case, you have a nice bank of good performance, freeing you up to do very sensible things, right? And we're looking at 15% compounded annualized equity returns. Like, I think a lot of folks in our seats are playing a little bit more catch up, because we've had very high tracking error, right? And that has cost us. So you're seeing Endowment's Foundation kind of moving more towards passives, not less, not nearly to the degree that you guys have had it and likely will remain. But that's not really probably the optimal direction of travel. The direction of travel is what I'm hearing from you, is contrasted investment grade. Fixed income is actually looking at raising tracking error, which makes excellent sense. So anyway, sorry for the long soliloquy on that, but I just think strong performance is great from a historical perspective, but it also puts you on kind of two solid feet, so you can do these very sensible things that will probably add value in the next 10 years.
And I know I joked with the treasurer at one of our IC meetings, and I told him, I said, you said you wanted more risk, and he said, I want more return. So, so we are balancing the two. All right, if there's no other questions, that wraps it up for us. Thank you.
Thank you all.
Over to the performance report.
Yeah, I'll run the slides and very brief action. So we popped over 200 billion as of mid-year. Most of the growth, of course, is coming from the equity components within these different pools, notably the retirement system, but actually the strongest growing pool that we're helping oversee is in the supplemental retirement plan. It's almost 70% invested. So the participants there have really benefited from the rise in equity markets globally. In terms of our macro positioning, not a whole lot has changed, and it's already been pretty much covered by Jeff. I think the one thing that we keep top of mind is that the market is really rapidly changing the narrative. I mean, it almost feels sometimes intraday the narrative is shifting a couple of times, and we want to be more deliberative. We have the ability, the luxury of investing over the longer term, and not having to be overly reactive to what's happening in the market. I think notably, it's really premature to determine what the net effect is going to be on global growth, profit margins from tariffs, deregulation, tax cuts, and the federal budget cuts. It's just, that story is not going to be written really probably for 9 to 12 months in terms of the actual effects rolling through the markets and profits. We do think the Fed is going to be moving to lower rates. By how much, who knows? Again, I don't know when we did these slides, a couple weeks ago, 3-4 weeks ago, and all these things have changed so much in terms of pressure on the Federal Reserve and the pressure points. So I'm going to jump forward to our positioning. I already mentioned this in terms of rebalancing. We had suspended rebalancing for a month, just given how much momentum there was in the equity markets, as well as good fundamentals from our perspective. But as of the 23rd of August, no, I'm not getting that date right now, but this month we did our rebalance, and so now we're back within. So this 2.34% overweight in public equity has now come down to a 1.9-ish, 1.
I haven't come down yet, we haven't finished yet, but we're right around 44% today.
Thank you.
We will be underweight.
Yep. We're well within all the statutory limits. And then I've already talked about the rebalancing, so I'm not going to belabor this. I do want to make a couple of comments on investments that we've closed. So you can see here's the example of what Rhonda and team were just speaking to. We did Revolut as a co-investment with Coatue on the 1st of August. So that's an example of kind of a growth name, a UK-based fintech. Private equity, we've had a couple closures with some longstanding relationships that had kind of gone quiet for quite a while. We're also doing some SMAs alongside some of these managers for co-investments. Those haven't closed yet. Non-core real estate, again, some very long-standing managers and relationships that have been closed. The DoubleLine and BlackRock Garnett, those are staging portfolios. So those were where we put the proceeds for rebalancing in early June. Melange Gulf Pipes is a co-investment that Andy has sourced. We've actually got a lot in the forward calendar. I'll show you in a sec some of that. And then Catalucci is a multi-strategy, separately managed account that we closed for $200 million. No exited investments, although we have some in process. And then our new fund pipeline stays very rich, our new investment pipeline really. And so you can see the top number of rows are all approved. And so they're in negotiations, final legal diligence. You can see some fairly sizable allocations there, including in private equity for a UK-based private equity manager, we were able to do a stable secondary as well as make some commitments to their funds and set up an SMA for a co-investment. So that's what's in progress. The public equity, growth equity, that's a fund structure, and that again is in the pre-market, pre-IPO space. So it's an example of what the team was just talking about. If you run your eye down a bit further, OFI special situations, we have $1 billion commitment that is under negotiation. So this is in the commercial real estate mortgage area. So we find that particularly attractive. Situation in the sense that it's a combination of providing solution financing to a relationship as well as a fund commitment. And then let's see, what other ones do I want to call out? We have under multi-strategy, tactical trade and opportunistic. So again, this would be a combination of a long-short fund in the macro space, as well as co-investments. So we're trying to do these where we have more concentrated positions, take on a bit more kind of active risk with the managers. It's not all funds, it's a mix of funds, co-investments, or separately managed accounts where we can do, various one-off transactions with them. Then last one, we've got the infrastructure co-investment. That's a large piece of what we're working on in the real asset space. We're also looking at some relationships that would be in energy continuation vehicles. So again, we see that as kind of a neglected area in the market where a lot of investors have shied away from that sector because of ESG concerns and things like that. We think kind of these are cash yielding, very attractive for our long-term objectives. So we have a lot going on in that space. We'll be able to give an update to the board in November on that. On the performance analysis, so we've had a really strong return over the past year, really just coming from the equity market. I think about 700 basis points out of that 9.94 is really coming from our equity investments. So that's the story. Thankfully, we've been ahead of the benchmark, at least the kind of the standard policy benchmark. This longer term policy benchmark is purely public. So we're behind that, but that oftentimes happens over shorter time periods because there's no illiquids in that benchmark. And then just another word or two here on attribution. So the right-hand side, top northeast quadrant, the selection effect has been positive as the allocation effect. So that's what we'd like to see. We're not trying to make outsized returns on the allocation effect, the positioning, but we do own that risk. So that's where the investment committee always starts its business every week, is talking about our overweights and underweights. And the allocation effect is further attributed down below. And you can see, with the exception of our cash overweight, which we've been intentionally drawing down methodically. So that's an accepted risk that's going to be a bit of a drag. It's more than offset by the other asset classes and the weak performance in non-core real estate coming from the market, the benchmark. That's been the strongest contributor on the allocation effect. And then the selection effect, you can see the outperformance that's come from public equity has really dominated as having 44% of the allocation. I'm going to skip the other, and just touch on this for a sec. So this is the comparison against what we're currently using as our peer group, which is the Boney Mellon U.S. public funds with more than 20 billion in assets. So on a one-year basis, our percentile ranking has been improving. I think in part because we're adding a bit more excess return versus our benchmarks. But again, against peers, this is going to be a a work in progress for quite a while. So on the margin, this shows the 5-year trailing and 10-year trailing in growth of $1 versus our average large peer. As we improve performance, which is what we're signed on to do, then we would expect this to close, that gap to close, but it's going to be slow moving. So my final comment is just here on the risk statistics. This is an area where we'll build this out over time, our risk budget, but we're generally in compliance. We look mostly at the 3 years, and we're a bit below in terms of our information ratio where we'd like to be. And the other is on the kind of the beta to the bond market, but otherwise from a risk perspective, we seem to be kind of in bounds as to where we wanted to be. So I went through that quite quickly. And since a lot of the 2 main asset classes, the largest ones were covered, their performance, I thought I would keep it quite brief. So happy to answer any questions or cover any of the other material.
So we will move on to public comments.
I believe there's none listed. Anyone here for public comment that hasn't registered?
We will consider the public comment period closed. Warn them out. All right. IC member Q&A. Anything on your mind that you want to bring up or we should discuss that we haven't yet touched on? Jamie or Lentz? Haven't heard much from you guys. Anything on your mind?
Pleasure. It's Lentz. Good.
Both of you. About
I just to express my appreciation for having been on the IAC and having ushered the retirement plan into the new board-led management. So I've appreciated everything and getting to know everyone, and I've enjoyed my time with the IAC.
Well, Lentz, you're not going far. We got you on teasers and elders, sir. Appreciate your service on both.
I'll still get to see many of you, but anyway, as far as the IAC goes, I've enjoyed it.
Yeah, and I'd say the same thing. It's been an honor. I appreciate the opportunity, and hats off to the team for the progress that you've made. And it's been a relatively short amount of time, and I think a lot of that goes to leadership. So hats off to the treasurer for leading the way here.
There's a lot of people in this room who deserve a lot of credit. Thank you.
My only question was kind of going back to the ORTEC presentation. You know, these little cells of data can take on like a life of their own, or like even can just have this impact that sometimes you lose sight of. And I was struck by, yeah, the very narrow returns relative to public expectations there. I thought it was good that they assume kind of only modestly higher betas to privates, but the returns themselves, like I said, are very low. Now, it sounds like where the kind of magic really happens is in the situational scenario planning that you do, where you incorporate your own views, your own capabilities, because I think that's something that ORTEC could never really help you with, and that's something really only a team and a CIO and a treasurer could do. You have a 40%, I think, limitation to privates. Is that right?
Illiquids, yes.
Illiquids. What is that now, and where would you like to get to that limitation within a certain time period?
I don't think there's like a glide path to get to 40%. I wouldn't approach it that way. And I think part of what we need to navigate is the traditional mix of reliance on funds versus co-investments and directs and things like that. I think that has to evolve significantly. And how that factors into illiquidity is yet to be determined, frankly, right? Because I think we know what happens with the fund commitment in terms of its illiquidity and the haircut you take in the secondary market. With the directs, And some of those could be less liquid publics as well. I think we need to think about them differently, both the role in the portfolio and then, you know, the illiquidity component. But yeah, I don't have a magic glide path. How much do we have currently?
Well, we have 75% what we consider level 1 liquidity, so basically very liquid, and then about 25% everything else. So I mean, I would say that really illiquid stuff is less than 20% of the portfolio.
Yeah. You see an extraordinary spread of return to illiquidity to want to drive up towards that 40% number. That's deliberately a much higher number than we have a cap. Now, we have some flexibility to operate if we actually get it up there, but I don't think that's the target. And as you heard, my skepticism that there's this forever and always illiquidity premium out there, given the capital flows to those asset classes, we'll test in each and every deal as we look at them. Kevin mentioned what we're doing in the mortgage space. To me, that's the perfect asset for this plan. High single digits unlevered with some back leverage in the low double digits, first mortgages. That's on offer right now, and that's, you know, cash flowing. Probably too liquid. We'll probably get refinanced out in the course of a couple of years. But I think we always got to keep in mind what it is we're trying to achieve, and illiquidity maybe falls out of that. There's huge excess returns to it. Certainly, we'll take advantage of it. We'll see those. Yeah. And I think the other aspect is thinking about it as a whole portfolio, right? So again, get away from this notion of being hidebound by buckets of asset classes with kind of narrow definitions. Think about it more in terms of like, what are we trying to achieve over time for the clients? And if I think about how insurance companies have approached the world, endowments and foundations, other investing organizations that aren't growing up in this strategic asset allocation concept, I think that's where we can also play. Some of it is just disintermediation. We have this long horizon, which gives us, you know, some clear benefits in terms of being able to take on those exposures. And if we get refinanced out, okay, fine, we find new investments. If not, we have, you know, durable higher returns and yields that are cash flowing. So they're very accretive, I think, to our mission. Another way to think about it, what's the net spend of Virginia? 2, 3? Yeah, 3. We're less than 2. Yeah. And so from a tolerance for liquidity perspective, we probably have more, theoretically, than the endowment community. But the endowment community is at 60.
In a sense, you're being very thoughtful about it. Direction of travel is probably to be higher allocation for investment in true illiquids, if you're paid for it. But in a kind of trending up liquid market, there is a short-term performance impact. It's difficult to completely avoid the J curve, though, and looking at your pipeline, I see a lot of secondaries, I see a lot of co-investments, and that will help. So that's just I would support that. I think you have the appetite and the ability to take more liquidity. There might be some messaging around some constituents around the performance impact of that in the short term. Hopefully not. And if, you know, liquids kind of someday become range bound from a return perspective, which seems like that would have happened by now, that would also, you know, help with that message.
Okay. So I've got a couple of comments. First, I would like to express my thanks for having the opportunity to be on the IAC as a Georgia Georgia resident. It's always good to get back to North Carolina and to participate in something like this. So my thanks all for inviting me to be part of this. But I do want to sort of put my Korn Ferry hat on. And for 25 years, I worked at Korn Ferry, and I did, as Kevin knows, I did a lot of work in the public fund space. And what that means is I sat at a ton of investment committee meetings and board meetings and got the really good sense for who are some of the high performing boards and what makes them high performing, and the teams and the investment committees. And I feel pretty comfortable that North Carolina is moving in the right direction finally. So I think you've got tremendous upside and headed in the right direction compared to what I see in the general landscape around the country. You would be shocked at the number of boards and investment committees I've had the opportunity to work with where you just scratch your head, and is because the individuals comprising some of these boards are not really adding a lot of value and don't have the backgrounds and the capabilities and the qualifications to really add value. So I'm really pleased to see the caliber of the people that the treasurer is placing on this board, and also just the caliber of people in this room who are working on the investment side of the house, because I've seen it all, and I think you guys are going to be in a good place. So I'll just part with that.
Yeah, no, I'd say one, and Kevin, like, I think you're being very thoughtful, and everybody is, about building the resources out first. Figure out what our strengths are and build those resources out, and then build evolve strategy around that. The world's, and it's a great opportunity to not be burdened by lots of illiquid stuff, and because the world is changing, very significantly. And it's also really hard to figure out. So, starting with people, I think will serve us really well long term. Right?
Well, thank you all. It's overly generous of you to offer your services to North Carolina this way. Appreciate all your efforts in doing so. Which brings me to the most awkward part of the agenda. I'm going to have to ask you to vote on a resolution honoring yourselves. There's no other way to do it. So
moved.
No. Sounds great. Well, I'm going to read it anyway. Since I didn't hear a second. All right. So the resolution, and obviously they're customized to each of you, says, whereas investment committee member served as a member of the investment advisory committee for the North Carolina State Treasurer, whereas investment committee member was interested in advancing the use of the teachers and state employees retirement system, the consolidated judicial retirement system, the firefighters and rescue workers pension fund, the local government employees retirement system, legislative retirement system, and the North Carolina National Guard pension fund, the Register of Deeds supplemental pension fund, and the retiree health benefit fund in North Carolina. And whereas investment committee member, through his leadership, made invaluable contributions to the work of the North Carolina Investment Advisory Committee. And whereas investment committee member rendered outstanding leadership in preserving and promoting the benefits of the retirement systems for its participants and their beneficiaries. Now therefore be it resolved by the Investment Advisory Committee, the North Carolina Department of State Treasurer, that investment committee member, the investment committee expresses its deep appreciation and gratitude. So on and so forth. I assume that I can take yours as a motion.
Second.
Now we got to call the roll. It was awkward.
All right, well, for the roll, we'll do it complete. Mr. Brewer.
Absolutely. Aye.
Mr. Durden again? Aye. Mr. Kennedy? Mr. Spencer?
Aye.
Mr. Ward?
Aye.
And Treasurer Briner?
Nay. No, I'm kidding. Aye. I also have gifts for each of you. They will look great on a mantle, and I will let you guys take them with you, and those on the phone, I will ship them to you. But thank you again for your service. We really, really appreciate it. And with that, we will look for a motion to adjourn.
So moved.
Second, Mr. Ward. Second, Mr. Jordan. Call the roll again.
All right, Mr. Brewer?
Aye.
Mr. Kennedy?
Aye.
Mr. Spencer?
Aye.
And Treasurer Briner?
Aye. We are adjourned. Thank you, everybody. And we'll start the NCIA meeting in 11 minutes.